So good morning, everybody. I think it's time to start. Before I invite Jaideep on the panel to put up an opening address for us. I think there is. You will find there are views on the attendee view, which will be like chat window and a Q&A window. So I would suggest any questions to any speaker you have it, please put it on a chat window. My team who's in the background is actually going to review all of these questions, and at appropriate time they would be putting it across to the speaker as well. If you have any problem as such, you can't view it, you can't hear it, any other problem, you should be able to put it on a chat window, or you can call up the person who has booked your seat to get sorted out. So offline also as well as online, we should be able to help you there. There's a live streaming happening, so you should be able to view everything. Your participation from a voice perspective would not be happening, but you can always put a text across, which we can put it across to speakers. The team behind the scene is every minute reviewing what you're putting it on a chat window or on a Q&A window. Second, I think there is an option to do networking. So if you want, you can catch up with your colleagues and peers. There would be a break time for you, and the platform will allow you to do that. Other than that, keep your mobile phones on silent. And I think, we should begin. Let me invite Jaideep. Jaideep is the CEO for Mosaic Digital for last 3 years now, Jaideep?
Yes, indeed.
3 years. And I think I have a privilege of working with him for last 10 years, 10 odd plus years with him. So, I may say, in the next 10 minutes, he would be sharing a lot of research and insights around the real estate to set the context for us and the agenda for us. And then from there on, we will take on forwards with the discussions. So very, 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 very warm welcome to everybody. Be safe, be at home. And Jaideep, all yours.
Thank you, Salil, and good morning to everyone, to our guests and speakers, and to the VCCircle team as well. Great to be opening this very important event up. I think, as you'll see very shortly, the real estate sector is one of the most important ones for the economy. And as we go through this unprecedented crisis and emerge hopefully on the other side very soon, this is a sector which is going to play a very important role. So let me just share a little bit of our own research from our VCC Edge platform, and also some thoughts that we have gleaned in speaking to some of the experts who are speaking later today, as well as from our own editorial team as well, and hopefully set the context for the discussions over the next couple of hours. So jumping in straight away, I think it's worth reminding ourselves that real estate is a critically important sector for the economy and for the country. It's a huge employment generator. 7 crore people are directly or indirectly employed in the construction sector and the real estate sector. And as per government figures, it's responsible for almost 10% of GDP. And that makes it about a $270 to $280 billion industry. Absolutely massive industry. The other thing which was interesting as we did our research for this event was that, most people think of real estate and they think of challenges and slowdowns and all of this stuff. But it turns out that over the next 5 years, this sector overall is actually forecasted by the government to grow faster than overall GDP, to climb to 13% of GDP by 2025, which means it's going to more than double over the next 4 to 5 years, which again, is both intriguing and makes it a very interesting conversation over the next couple of hours. And all kinds of sectors, housing, infrastructure, commercial real estate, malls, leisure, etc. Everything is forecast to be growing, though I suspect that our speakers might be able to update some of these sectors given some of the changes we are seeing by the coronavirus situation and possibly beyond as well. Okay. If you take a long view, what we find is that, in India, about 34% of people live in urban India at the moment. And this is 2018, so you can say maybe it's 35 or 36% now, as urbanization has been happening over the last couple of years as well. But broadly speaking, if you take about a third of India as being urban India, What we find is that the Asian average is about 55 to 60%. And indeed, the developed countries of the Western world, urban populations have actually gone up to 85, 90, 95% mark as well. But we thought the Asian numbers will be a better peer-to-peer comparison for the point we're trying to make, which is that about 250 million people, give or take, are going to be moving from rural to urban areas over the next decade. And what this means is that we're going to be looking at somewhere in the region of 50 to 75 new cities being developed, both brownfield and greenfield. And keep in mind, I've taken an average of about 4 to 5 million people per city on average. And to give you some context here, Jaipur, for example, today is a 3 million people city. So there's some very, very serious urbanization which is going to happen over the next decade, maybe next 15 years. And it's going to create some amazing opportunities for the real estate players and the real estate financing community as well. I mean, just one example, if you take a simple average of 5 people to a family, which is broadly where India is today, that means that one of the metrics you can think about is 50 million new housing units to be developed in these new urban areas. And of course, there's a myriad sort of other infrastructure, which I've spoken about earlier as well. So if you take a slightly longer view, what one finds is that actually there's a lot to be excited about in the real estate space. And really that, the country is going to keep seeing more construction activity all around. But what we are also seeing is that this construction activity is going to look very different 5 to 10 years down the line than it has looked 5 to 10 years previously. And what we mean by that is that, PropTech or property technology or real estate technology and smart city technologies, which is, again, a whole host of technologies in the smart cities basket like IoT and AI and so on, are going to be pivotal for success of urbanization in the decade. I mean, we all know, many of us, in fact, I would imagine all of us on this platform actually live through the mess that is urban India every day. And we have an opportunity to, fix cities retroactively to some extent, but definitely the new ones which will need to be built, we can look at, making them sustainable and hopefully giving all citizens cleaner air to breathe and, cleaner water to drink and so on. With all kinds of transportation technologies coming through in the autonomous driving revolution, driverless trains in the metro systems, smart parking and smart traffic management systems, there's really a huge opportunity to drive a next level of efficiency across all our urban landscapes. And technology is going to be in the middle of that. And not just that, even at a housing level, at a building level in the apartment complexes, from crime prevention to security management to smart lighting on staircases to smarter HVAC systems, all kinds of new technology is pervading the ecosystem. And this is going to drive a real revolution in the real estate space overall. And I'm sure you'll all want to hear from some of the speakers later in this event on some of these as well. But we're certainly seeing that happening. And PropTech is one of the booming areas at the moment in the overall startup ecosystem. Having said that, if I were to now come back to a more sort of current view, while the longer term potential might exist, the short term and the current situation is somewhat bleak. And indeed, I would imagine it's a crisis. So the one of the early indicators has been that FDI in the construction sector has been steadily declining according to our research and from what we've gleaned from government sources and so on, and also deal declarations. So 2,500 odd crores in 2017, down 10% by April to December, the 9-month period of 2019. And you can only imagine this curve is going to dip even more sharply when we go through 2020. In fact, if you see some of the early trends, you'll see that the current situation is most definitely a crisis, and the lockdown and other challenges which have been the outcome of the COVID crisis has meant that construction activity has come to a standstill. Developers are facing an unprecedented liquidity squeeze. I mean, it's not like they were kind of doing really well earlier. There was already a financing challenge, and now that's been sort of amplified. the reverse migration of labor back into rural India as a result of the lockdown and some of the horrifying humanitarian stories we've been witnessing. One of the unfortunate outcomes is that there is a shortage of labor that the construction sector is now facing as it reopens. And I'm sure all of you are following the news with, especially on the commercial side, rentals under severe pressure, further driving away investment from these sectors. And to just give you a couple of kind of data points on that, in office space, we were looking at completions of about 47 million square feet pre-COVID, and that's dropped almost 20% to 40 million square feet. And keep in mind, commercial real estate was one of the more steady, almost I would say the shining star of the real estate sector over the last 4 or 5 years, as the other segments had kind of struggled. And similarly, I mean, if you take retail, for example, the dip is even sharper. And in fact, I would personally imagine that the dip from 6.2 million square feet of new absorption or sales to 4.3 million might actually be underestimating the scale of the problem in some ways. But I guess we'll find out as time goes along. So some anecdotal evidence for you there. And if we look at the last 4 or 5 years, and this is research and data from our VCCS platform, what we find is that since 2017, you can see whether it's movement of private equity funding into the sector, mergers and acquisitions transactions, indeed exits, investors being able to get their money back. The trends have been quite troubling. The first quarter of 2020, and in fact, if you look at even now through to the end of June, the deal volumes, the deal value, and the transactions have all dipped very, very sharply indeed. In fact, it's pretty much a calamitous collapse here. The other thing which is a bit worrying is that this year is seeing a complete lack of new real estate funds being launched, which also creates a little bit of a financing challenge for future years. As funds launched today and net funding raised today would provide rocket fuel for the sector maybe 2-3 years down the line as those funds close and start to deploy. So that's something else to be a little bit concerned about as well. And I'm sure in the next session and beyond, they'll be touching upon some of these areas. But even as these volumes have dipped and so on, what we've also seen is that some of the most prominent investors from around the world have actually planted their flags very firmly in the country. I won't go through all of these, but all of you will know about Blackstone and GIC and Brookfield and so on. And you will see that they've had varying deals in terms of deal sizes, the kind of deals they've gone after. Commercial real estate has been the biggest area, but there's also been a ton of funding which has gone into residential complexes and so on as well. So I'll end over there with some questions which we should all be pondering about. We're in the sector's in deep trouble at the moment, bit of a crisis. What happens next? How does a sector which traditionally has not, let's be fair, been the most welcoming to new technology, how does it now embrace new technology to make itself more sustainable, more efficient, and really more viable for investors as well as for its customers here? With new regulations coming in and RERA's impact is already seen, how does the industry and the folks who are providing the financing relook at risk management practices? What is the impact of COVID in the context of risk management? And indeed, liquidity, cash management, debt financing, equity financing, all of these are big questions that the sector needs to answer to be able to really realize its potential and grow from 270, 280 billion today to 600 to 650 billion over the next 5 years. On that, hopefully, realistic but optimistic note, I'll conclude. Thank you for your attention, and Swet, I'll hand over to you.
Thanks, Jaideep. Okay, so before we get into a conversation with Rohan, I'll give a little bit of background about Xander Group. So, Xander Group is a global investment firm focused on emerging markets, and they have put in capital to the tune of 3 billion USD in Indian real estate markets since 2005 across office, retail, industrial, and so on. They also have a credit platform in India through which they have put in roughly 3,500 crore. So, just to talk about all of that, and what's happening in Indian real estate market, like we discussed, Rohan, the way ahead, where is it going? So let me first of all understand from you what's happening in commercial real estate market. We have seen how work from home is getting popular. The world economy at large is impacted, so companies are going to hold on to their expansion plan. What's happening on leasing? Are you concerned about a drop in leasing that people are expecting in near future, or maybe in medium to long term? What's your sense? Are you particularly concerned about your portfolio and the market in general from leasing perspective?
So firstly, Sarika, thank you firstly for having me. And these are very, very pointed and difficult questions to answer, given where we are, but I will do my best. I also noted some of Jaideep's comments and, pretty much a gloom and doom scenario that was painted, and perhaps rightly so. And I'm a big bear myself, frankly, but I'll try and change the mood a little bit and curtail myself from making too many negative comments.
Okay.
So, how about that? So let's start on that note. Okay. So firstly, the thing is, what worries us? Firstly, as investors, we're always worried. Our job is to worry, unfortunately. So you're always worrying about something or the other. Obviously, where we are today, uncertainty is something that we deal with anyways, but obviously it has been amplified to a large extent today because, I won't get into the health elements of this because I think people have all by themselves become coronavirus experts, and I don't claim to be one, so I won't go in that direction. But I'll try and answer your sort of pointed question around commercial real estate. It's for me, my view is that it's early days. If you think about it, we have been locked down now since, let's say, give or take, different jurisdictions, but let's say mid-March to now, which is 2 months, let's call it 3 months. I think it's been a forced lockdown. And I think this environment has actually been quite productive for the office sector, for the services sector. And we all know that the office sector predominantly caters to the services sector of the economy. And there are numbers floating around and being published. I just read something yesterday that Pune achieved 18,000 crores from predominantly being work from home status. These are STPI numbers, exports. So I think firstly, the business continuity planning, I think it's been a trial by fire test for BCP during this time. And I think companies have come out quite well on that front. Now, what does this mean for the future? I'm going to make a few points. I don't think I'm going to make any predictions. But fundamentally, we need to first understand whether this BCP mode will continue and for how long. And that is going to be driven by what governments and the health situation and cases and the penetration and the alleviation of the virus. But let's carve that point aside because none of us can answer when things are going back to stable, right? When people will be free to go out, will feel safe to go out, and that's obviously only when a vaccine will be administered and people feel safe again. But are these 2 or 3 or 4 months going to change lifetime trends? I don't know. Are people never going to go back into the office? I don't think so. Is it going to modify in some shape or form? I think so. By the way, this work from home concept, right, has been going on for 20 years. And I can say with fact, because in a previous life, 20 years ago, when I was a consultant in a previous life, I remember doing an Asia Pacific strategy for Cisco, which is a large technology, on replanning their Asia real estate portfolio, and a lot of it was work from home, right? So there has been a slice of this pie that has always been directionally moving towards work from home for various reasons: productivity, long commute times, decentralization, BCP, several motivations, which I think are all valid.
Right.
What this time is going to do is it's going to accelerate that thinking, right? And it's also, by the way, given people time to think rather than time to kill. I think people have had time to think. So I think several corporations have, I think all of them, have set up task forces to wrestle this issue, saying what is the formula going forward? I don't have an answer. So these are just some of the things that I want to share with you. As far as the portfolio is concerned, frankly, I don't think we've seen any sort of SOS calls from any of our office tenants. We've closed, frankly, a fair amount of leasing during this period. Any conversations that were had pre-COVID, which were advanced, have closed. We have, I don't think we've seen an issue, but I also think it's too soon to tell, right? It's been 3 months. I think people want to continue to maintain their infrastructure. We've been open. We've been providing all the support. People have been able to do BCP because the offices have been operational from a technology and power, life, health, safety perspective. So I think it's come together as a collaborative effort to keep businesses going.
Okay.
If this is going to continue for 5 years instead of 5 months, then obviously the conversation is different. So I'm not, like I said, I'm not going to be able to answer your question, but I'm going to give you some things to think about.
Right, understood. You were saying that it's kind of too early to sort of comment on where things are going to move, right? But what your tenants are saying, what occupiers are saying, what concerns do they have? When they talk to you as a mall owner or an office owner, what are the concerns that they're presenting to you?
No, I think
and have you been able to sort of, just to follow up, have you been able to resolve some of them?
Yeah, so I think the only concern, frankly, which is more internal to us rather than externally communicated. In fact, we've kind of got appreciation from several of our tenant partners, has been health and safety for our employees, for our stakeholders, and for our clients. And I think we have obviously, and I think a lot of institutional owners across the world have done this, but I think that element of confidence needs to be, and it's just a question of reinstating confidence. It's a question of just doing the right thing, right? This can be obviously fatal. We can debate mortality rates, but you got to do what you got to do. So obviously things like sanitization, screening, thermal scanning, all that good stuff I won't get into, has been right at the forefront of our agenda, and it's been a lot of work, frankly, on the operating side. I think tenants have appreciated that. I think a lot of the tenants have been driven by, and a lot of our tenants are multinational companies, large corporations. They're being driven by, perhaps, and rightly so, their global policies, because they have obviously, a great amount of care for their employees. And hence, I think the conversation so far has been not around economics, but more around safety, saying how can we do improving, learning, and adapting to the environment.
But Rohan, one thing is to look at it from health and safety perspective. But what about rent waiver, rent deferment, or maybe renegotiating rentals, maybe across your office portfolio or retail portfolio? Is that happening? Has that happened? I mean, what kind of conversations are you having with your tenants from that perspective?
So I think the two asset classes sit in different buckets. I won't kind of refer to them synonymously. I'm talking about office. Office has been simple. I don't think we've had any such sort of discussions because things have been operational. Our site teams have been operating. Essential services has been operating. People have been working. You can see through power consumption and through activity of servers that everything is operational. So I think the debate in office is, frankly, not really there. Right. I think for retail, it has been, obviously retail has been more impacted just due to the nature of the business because we haven't been operational.
Right.
From mid-March, certain governments shut down, and we have only opened a fraction of the portfolio this week. So it's been quiet for 3 months. So frankly, there has been no conversation. But I think the team is working constructively with all our partners. I think the good news is that there is this eagerness, and I think that is very important. There is an eagerness not only from the retailer side to reopen, but also from our teams to go back to work, to go back to doing business. I think that level of enthusiasm and eagerness is critical for the business, notwithstanding all. We don't want that safety. We don't want safety matters to get compromised because people are eager. So don't get me wrong. Consumers are, right? Again, it's perhaps too soon to tell, but consumers visited the center. Shopping is happening. So it's happening obviously not at the level of pre-COVID. I think, but it's happening beyond sort of expectations. And I think the retail landscape in terms of the type of counterparty or your tenant partner or whatever you want to call it is so varied, right? So there is no standard conversation, right? Obviously, so there are different types of conversations. I don't want to get into contractual conversations here, obviously.
Right.
But I think the good news is there is a collaborative, constructive discussion. People have reopened. They continue to reopen. I think a few have kind of said, okay, let's see how the first few goes with the others. First few days go with the others, and then we'll reopen. So we have more people opening on this weekend, et cetera, et cetera. So I think it seems to be heading in sort of a positive direction. Where it will settle, I don't know, because at the same time, if governments choose to be and perhaps rightly so locked down again, because if cases don't come under control, or India doesn't get to flatten the curve, then that might happen, and that might have to you need to press the reset button again. Right. So it's all kind of like I said, I don't think I have a concrete answer for you, but I think the general trend seems to be in the positive direction.
I appreciate that you're presenting a very positive sort of picture, but but what happens to rentals? I mean, not particularly about your portfolio, be it commercial or retail, but there is a lot of uncertainty. People are not going to lease. I mean, I know rentals are a sort of equation of demand and supply. Supply is also going to get sort of limited and constrained because of the labor issue and supply chain and all of that. But what happens in a market like this? What happens to rentals, be it in commercial or a retail segment? Will there be some softening, and what kind of softening?
Yeah. So Sarika, I would kind of take even one step back from what you stated, right? Which is where the rentals and it's a question of demand and supply. Sure, it is. I don't disagree at all. But let me take a step back, given that we're in a crisis situation. Right? This is a crisis.
Right.
Let me not sound positive. This is a crisis. We're dealing with a crisis. It's a health crisis. And it is a financial crisis. There is no doubt about it.
Right.
Now, I think the point that I would like you to think about is rentals are a function of business. First, you've got to realize that do people still have a business? Mm-hmm. Right? Because you will only need infrastructure if you still have a business.
Right.
So I think that's the first thing to assess. Right? As a corporation, do you have a business? Because remember, no matter what, obviously there are legal contracts and people are bound by contracts, but over 5 years, if people don't have a business, or even 3 years, right, then they don't have a business. It's as simple as that. To acknowledge, all parties around the table have to acknowledge that there is no business.
Right.
Then there is the point of, okay, this is a it's a tough time. Let's kind of work it out. So I think it all falls into different buckets, and then comes the whole demand and supply conversation. Mm-hmm. And our indications of the first few months of this, and like I said, I think it's too soon, so I don't want to sound superbly optimistic, is that people seem to have a business still.
Okay.
Right? They're still saying, we want to open, we want to run, we want to work, we want our offices open, we want to pay whatever the construct might be. So I think in a crisis, first you go right back to the basics. Don't even think about demand and supply. First thing, is there a business or is there an economy or not? Is there consumption or not?
Right.
And if there's not, or if it's muted, then how long is it going to remain like that? Which is why I think balance sheets on both sides are going to play a big role in this, right? Whether it's asset owners like ourselves, right? Or it's operating companies, which are the users of our infrastructure.
Right.
Right. The other element that I would like to add here, specifically since you asked me about office, is that some of the things that are changing is flexible office. Right now, I keep hearing that obviously the co-working side is suffering. A lot of operators are suffering, etc. But again, that's where balance sheet is also going to play a big role, because it's intuitive. If you think about it, people will just want more flexibility. They will need to plan their continuity processes. And we're already seeing, that kind of early signs of that in our co-working. And in fact, I call it a flexible space portfolio, because co-working is nowadays, right? And all of that. So I think it's this is a very complex equation.
Yeah.
So many moving parts.
Right.
I think you just have to, at every given point in time, receive all the data, assimilate it, and then craft your strategy going forward.
Sure, understood, right. But there is a lot of gloom and doom in the market, as we all can see and understand. But do you think, this is also a good market from acquisition perspective? Are you going to sort of look at more assets in retail or commercial because valuations are going to be attractive and you'll be able to clock a good deal? Do you think that's going to happen, or you will sort of be cautious in deploying capital going forward?
Yeah. So look, like I said, in our business, pricing uncertainty is a very, very important sort of trait that we need to have,
Right.
right? And I think the whole at this point in time, are we looking at new acquisitions? The short answer is yes. Are we being obviously with an increased margin of safety? And margin of safety comes in different. It's not just price. It comes under several other metrics that contribute to that margin of safety. And obviously, it will be a moving target for us, not in terms of as we learn. So we also have the benefit of a operating portfolio with scale. So we get a lot of information from our own portfolio, which will direct us to take investment decisions for the future.
Right.
Right. So if we're seeing massive, for any new space coming online, if we're seeing massive rental reductions, then obviously we'll factor that into our underwriting going forward.
Right.
Right. Small example. We will be conservative on debt. We will conserve cash. We will look at every element of capital expenditure with a fine sort of, in a microscopic manner, which we're already doing, which is, I'm sure a lot of companies are doing. So I think it's about sort of the best risk-adjusted returns from our lens, and everybody's lens is going to be different, which is why deals happen. If everybody thought it the same way, then there would be no deals. So I think the answer is we've actually been quite active on the investment side. Pipeline looks interesting, but we are facing some of the things that we've never faced before. Is like, how do you diligence these deals?
So are they all on hold right now? I mean, how are you going about that?
Whatever can be done remotely can be done remotely. And as the market opens, then we'll have to, because I think diligence requires and deal closure, in my opinion, and I'd love to learn from any of your panelists or anybody else of how people are doing it. But I guess some things can be done remotely, but I still feel there's a physicality to the process, which we're dealing with at this point in time.
Okay.
And maybe that would soften. The problem would soften over time as things open up.
Right. Understood. But I would also want to understand from your perspective on warehousing. You recently set up a platform worth 250 million, and then you were looking at acquiring a lot of assets under that. Do you think the timing is right? Because a lot of people anyway, people had moved to online shopping, and the trend was getting popular. Do you think that trend will get further cemented even in smaller cities and tier 2 markets, and therefore the demand for warehousing will sort of increase? What is the market like for warehousing assets, and where do you see it going in the next few quarters?
So I think you called it right, and I think this is not only this is a global phenomenon. I don't think it's just an Indian phenomenon. It's quite a secular trend, with stuff moving online, etc. Commodities moving online. We're seeing strong demand from e-commerce players who are our existing clients across our industrial portfolio. I think there is anything that's under construction, there is a high demand for immediate completion, despite lockdown. So it's kind of a conundrum, like how do we complete when we're locked down? But it's a good testament for demand, specifically with the e-commerce companies. There's no doubt about that. I think there seems to be a severe shortage of space. When I say space, I mean institutional space that such companies would kind of sign off on and occupy. And I think right now it's a supply side issue, frankly. And let's not underestimate the supply side issue here, right? Because I think Jaideep very rightly kind of made some important pointers around construction activity, migration of labor, just movement of supplies, import, a lot of, there's import of product, and some of these things. So these are all supply side problems. They are not demand side. So I think industrial is going to face supply side issues more than demand side problems.
Okay, understood. So I've been told that we are running late. So one last question for you. Tell me 3-4 things that you're going to focus on in the wake of this coronavirus pandemic, and sort of that gives strength and muscle to your portfolio and to your strategy. 3-4 things that you're going to focus on actively.
So we're going to focus on worrying more, because that's just the nature of our DNA, number one.
Mm-hmm.
I think we're going to focus on health and safety, which is a new thing, by the way. Let's not get ourselves, right? Health and safety is something, of
Tell
course,
me from
everybody.
capital deployment perspective, health and safety, everybody's sort of concerned about. But let's say
Yeah.
if you had to deploy, 500 million from a pre-COVID strategy, how has that changed as a result of the
No,
current
I think
situation?
firstly, we don't work off number targets.
Mm-hmm.
I think that's a dangerous thing. We never have in our 15 years.
Mm-hmm.
We have obviously had spurts of, investment of high numbers, and then we've been quiet for a long time.
Mm-hmm.
And as that behavior might kind of portray and depict, it's a question of what opportunities we see,
Right.
right? I've seen some good opportunities in the last couple of months. I can share that with you. We've had some closures of commercial negotiations that we think make sense. So that's the question. We need to build in a margin of safety in our thinking for sure, which is where rents go, what occupancy look like, and etc. and around that. On the credit side, which we haven't talked about, I'll take a minute there. We have, fortunately, even before the NBFC crisis, felt India was in a credit bubble. So we started unwinding our book from, I would say, mid of 2018 or even earlier than that. So we're now sitting on a book which has a capital adequacy ratio of almost 60%, net debt ratio of 0.5. We have undrawn credit lines. We have cash to deploy. So that team is very, very active at this point in time when the market is generally very, very quiet around the NBFC space. I think that team is raring to go with investing. And the question is, what are the right opportunities, and all that is on the card. So I hope that engine will fire, quite well in the next, 3, 6, 9 months. It's a good time to build it. And across the other asset classes, I think you have a sense of what we're doing.
But will you, from your credit platform, will you be sort of cautious because, given the... Okay, you're going to be aggressive, you're saying.
No, aggressive. I think aggressive, you can be cautiously aggressive, right? I think that if we see deal flow at the risk-adjusted returns that we like, we'll be aggressive, which means we'll do more. If we don't, despite sitting on liquidity, if we see stuff that we don't think stacks up, we won't do anything. But I think the initial indications, given the fact that there was generally a liquidity crisis even pre-COVID, I think COVID has deepened that problem. And that we're seeing early signs of interesting deal flow basis that.
Okay. But there are also emerging sort of asset classes. Just one last question. Emerging, asset classes in real estate, there is a lot of focus on data centers, and people are saying because of the present situation and things were anyway moving in that direction. Would you look at data centers as an asset class? Because that's kind of really interesting from investment perspective.
Very good question, and thank you for asking it. The data center theme actually is again not something new, but like I mentioned, with every theme that has been on the cards, I think COVID is accelerating the thought process around it, which is I think topical for data centers. Given that we own a reasonable scaled office portfolio with expansion, etc., we have been in talks with data centers even before this time. I think India generally has challenges. Let's call a spade with data centers, because there's a bunch of requirements with infrastructure requirements that sometimes get challenging. But yes, it is an area of interest to us for sure, given that we have the product. I mean, we have the raw materials, and those conversations are also getting accelerated. And the way it works is they require very suited infrastructure. You can't. It's not a cookie cutter model. You need to really build it for them. For a very, very specific use, and every operator has its own kind of set of requirements in terms of density, infrastructure, whatever. So yes, short answer is it is an area of interest. Now, if we are able to match the requirements of qualified operators, we won't work with just anybody. then it is an area that we are absolutely able to cater to and focus on.
Okay, interesting. So we are ending on a positive note. Thank you so much, Rohan, for your insights and for your inputs there. And so that brings us to the close of this conversation. So I'll hand it over to the host now. Who's
Thanks,
next?
Sasha.
Yeah, thanks, Rohan. Thanks much.
Hi, Sweet. There are a few questions, if you can take those questions.
Okay, so we have some questions, Rohan, for you. Just a moment.
Can you see them?
I should be able to see. Just a moment. Yeah. Okay. Okay, so there is a question, Rohan, for you. I don't know who has asked, but it says, is there a major demand upside in the IT industry that one is missing?
So look, it's a very, very interesting question. And let me give you a data point that happened earlier in our last financial crisis, which was in 2008, where I think because of the drive in a financial crisis to optimize costs, save costs, etc., I think the IT industry got a major fill-up during that time. So if you look at office demand, and 2009 was basically for planning, and then from 2010 onwards, even though economies were still finding their feet, I think India saw a major office demand, and then that run has continued for a few years. There is a thesis out there, debatable again, is that will that happen again? Because again, as you know, most of this business is driven by multinational companies. And there is obviously a pressure on the bottom line, and this is obviously an opportunity to optimize cost. And the other positive part about this is that the industry itself today is far more established today than it was in 2010 in terms of the depth of the industry, in terms of the availability of the talent pool, in terms of the training options, and whatever other raw materials you need to make this productive here. So on the positive side, I would say, yeah, there are those elements. On the other side, people, where the negative side is, given the financial crisis, people just may not have a business, right? So the volume of business for these companies could just be at such a lower level, a lower threshold, that it will not warrant, whatever capacities they have right now will be sufficient. So that could be a more step, So those are the two views that you could adopt, and again, it's going to crystallize over the next few months, I think.
Okay, cool. So that brings us to the close of the conversation. So thank you so much, Rohan, once again, and look forward to talking to you again.
All right, take care.
Yeah,
Thanks
much.
Rohan.
I'll hand it over to Ved now.
Thank you, Rohan. Thank you, Sweet. So hi, Beena, if you take over the next session.
Sure. So after a cautiously optimistic conversation, I think we should move on to one of the critical aspects of access to capital for the real estate sector, which is obviously something that is being talked about of late a lot. Quickly, I'll just introduce my three panelists. I'd like to call on Amit Goenka, the MD and CEO of NIFCO, which offers funding, asset management, and investment banking services in the real estate sector. We have Puneet Bhatia with us, who's the Senior Director, Real Estate ICICI Venture, which is one of the oldest PE firms in the real estate space. And we have Ambar Maheshwari, who's the CEO of Indiabulls Private Equity, Indiabulls Group Asset Management. So welcome you all. And just to quickly, just mention that, RBI has RBI has injected liquidity, cut interest rates, yields have fallen to less than 6%. We've seen investments, private equity investments have dropped. Now, I want to quickly move on to asking, how returns have varied across this modes of capital in the debt and equity side in the real estate sector, and how developers are leaning to which mode of capital to raise funds. So quickly, if I could just start with Amit, how are you seeing the whole investment eco space, and which are the modes of capital that is preferred right now over the last 4 to 5 months? How was it before COVID? How is it right now? Amit, I think we can't hear you.
Hi, Amit. Can you unmute yourself? I think you are on mute. Or maybe if you can use the headphones, if you have.
Is there a technical issue maybe?
Just select the of the audio option where you'll find the headphones. Just select the audio options in the voice control. Just click on the microphone button at the left side, right corner, and select your headphone.
Okay, I think while issues get fixed at Amit's end, could we move to Puneet? Puneet, if you could point out and firstly unmute yourself, yes, thanks. How do you see the whole access to capital, on the debt and equity side? How has it been pre-COVID and post-COVID?
So, first of all, good morning, everyone, and let me thank VCCircle for giving this opportunity. And it's good to be amongst friends. Both the co-panelists are friends for a long period of time. Coming to a pre-COVID to a post-COVID scenario, I think we need to really look at the sector in a totality. And if you actually divide into various asset classes, largely on the residential side, I think we were already into a certain issues related to a debt side, and the equity was non-existent. I mean, as of 2019, when you look at the top line number, 92% money has come in equity and only 8% has gone in debt. But when you actually analyze it further, all this equity money has actually gone in the stabilized, core, yield-generating assets. Residential, which is almost 85% of the market, has only received 11% capital. So there's definitely a mismatch in terms of where should capital would have been there or not. One interesting thing till pre-COVID also we were witnessing was that the debt was expected to give equity kind of returns. Which probably doesn't really make sense, but that is what has been happening for a period of time. Where it was believed that the nature of the debt could still be in equity in nature because of the kind of practically no equity in the projects per se, but largely the high lane early 20s kind of debt is something which the market has witnessed. I think post-COVID, what is really happening, and is we still are only a couple of months there. But what has happened is two aspects. So there's definitely a trend of, the stress funds which have come in and started looking at funding. So case in point, the likes of Swami Fund from SBI side has in fact reduced their rate of interest from 15% with a benefit of 14, and now currently all cases that would be done at 12% IRR. So that is not even a regular coupon. But I think Swami is an exception to the market. Largely the investors would look at stress opportunities because this would be an opportunity to fund in the stress space. So that is one trend I feel would happen. The second trend I feel is that because fairly the party is over for the core yield generating stabilized assets, so we would see attraction of capital in the under construction office also, and there have been some platforms which have been announced towards that side. We will come to the logistics and other sector in a bit, but overall, residential and office, which are two large sectors, this is currently the trend, Beena.
All right. So just moving to Ambar, what are your thoughts in terms of the situation right now on access to capital? How are you viewing the situation?
So, Beena, I think it is going to take time before capital is available for real estate. It is, an unprecedented time all of us are facing at one time. And really, capital comes in where there is demand, right? And today, in the uncertain environment that we find ourselves in, demand is a challenge and will continue to be a challenge for a while. Before we talk about where the capital is going to come from, or while we talk at the same, we also need to talk about where this capital will be serviced from. Right. Today, servicing of this capital is a challenge. I don't think it is possible for residential developers to find demand or cash flow, could service this capital. Commercial real estate, the existing rentals, most of the assets, in fact, almost leased out, are levered already. For under construction commercial projects, I'm not sure where the capital is going to come from in a hurry, because again, this situation is very, very uncertain at this time. The two schools of thoughts on whether the commercial real estate take-up is going to go up or going to go down, still not clear. So right now, I don't think it is a matter of accessing capital. I think it is a matter of preserving where your projects are. Right. And from that perspective, the government has actually given out a good push in terms of giving moratoriums, in terms of revoking the IBC, where, you can't take anybody to an IBC over the next 6 months, extendable by another 6 months and so forth. So right now, because of the uncertainty, once things become a little more clear in terms of where this is sitting, how is it settling? Let's get the health issues sorted out, and then determine the impact. And that is when I think capital will be available, because, servicing the capital today is going to be a challenge.
Sure. So access to capital exists, but servicing it is a little difficult. Amit, could I get you on the same?
Yeah, hi Beena. Can you hear me now?
Yes, we can. Thanks a lot.
Sorry for the technical glitch. I don't know what went wrong in the last minute. I was enjoying the previous sessions. It was extraordinary. Both Jaideep and Rohan has actually stolen the thunder for a lot of us, and rightfully so. So Beena, in terms of your question, going back to what was earlier and what is now. So I think even while there has been a problem in terms of overall liquidity supply over the last 1.5 years. But however, having said that, we did see a reasonable amount of money being made available through funds, through banks, through NBFCs, and through various other modes, including some investors, internal accruals, etc. What we've also seen that people were willing to go ahead and take capital, launch projects, and willing to have a continuity in their business planning. What we've now seen, however, is a fairly tectonic shift in the entire outlook. And Rohan talked about supply side constraints as being the new issue. So we've always had demand side. We have always had demand side issues. We've had liquidity issues, but what this pandemic has done is actually created supply side issues. What that really means for capital providers as well as for capital seekers is they're unwilling to also sign on the dotted line. They're unwilling to underwrite a business plan. They're unwilling to actually take any liability or give any assurances, either in terms of sales or in terms of actual supply completion dates and any of these other assumptions that would be very normal or very standard for anybody to give in a heartbeat. So I think therefore the deal volumes have slowed down, not just because of the fact that they may be lower capital, but because people are also a little wary about accepting capital. The other thing that has happened is that I think people have conceded to the fact that it's not about the cost of capital, but it's about the availability. So despite the reverse repo rate cuts, despite a lot of the liquidity and TLTRO measures undertaken with the RBI, there's not necessarily been a transmission of these rates to the real estate sector for a multitude of reasons. Now, despite the fact that the capital may not have really become very, very, very cheap, I've seen a lot of conversations in the last couple of months where people have actually started looking more and more at equity-linked structures, profit-linked structures, and a lot of people, including those who are willing to provide the capital, also willing to go down that path. Right. Saying, okay, yes, I'm willing to consider more time. I'm willing to consider the fact that I may not get a fixed coupon or a fixed clip rate on my money. over the next couple of years, but I would be happy to participate in your profits. And so there's a lot more rationality, I think, in terms of conversation in being willing to share that upside, which was earlier a no-no. That this is your share of the returns and this is the rest of the profits are mine. It's a non-negotiable situation. So I think that certainly has moved. We saw a few of the equity-like transactions happen even pre-COVID, where a Mumbai-based developer tied up with a Japanese fund and took 300 crore rupees. We've also seen Korean investors come in for the first time and provide significant capital, including at platform levels. We've always had Singaporean, Canadian, and other investors who actually done platform deals. So I think there is certainly a mood for people to look at India as a new destination and looking at the opportunity that may lie within India. Whether that money is going to rush in immediately, obviously not, because of the current lockdown, the current situation, and the fact that we still don't have a handle on how our businesses can actually resume to normalcy, given that we're not flattening the curve fast enough. So I think notwithstanding that, there is a slush of capital in the global markets, and there clearly is a need to realign some of that to emerging economies which are likely to sustain the onslaught, which are likely to show positive growth. I think there are also indicators that we may actually bounce back in terms of GDP growth next year, and it may not look as bad as people are estimating it to be. We've seen services resume. So on the back of all of that, I think there is clearly an indication. We've seen, very recently, last week, some of our investee companies or potential investee companies also having conversations with equity partners and as well as global funds on actually taking on new capital. So clearly the mood has shifted to more equity-linked structures rather than underwriting a debt. The mood is also to conserve the amount of capital and resources available in the company and not sort of take on more leverage or take on more capital burden within the balance sheet or be able to service it, and therefore more collaborative environments. Third, also see where is it that one can actually find resources, whether capital, land, construction material, labor, and create a sort of a interlinked ecosystem within the supply chain rather than actually be self-sufficient or self-dependent. So people are borrowing equipment, labor, technologies, people, and a lot of other resources from friends or within the industry to supplement that need for capital as well.
Correct. So as an investor, how do you really see, where is the investor appetite when it comes to, fundraising and investments? Which asset class looks more promising in the whole current scenario? And as an investor, what do you look for when you, plan to raise funds or invest?
So, Beena, squarely for us, first of all, I still believe that mid-income and affordable housing story is robust and will continue to be robust in the foreseeable future, despite the hiccups that it may have faced. Sure. We're not necessarily very focused on commercial or warehousing or data centers or any of the other new asset classes, clearly because some of the new asset classes have untested track records in history. Mm-hmm. Second is that we're not entirely sure the way the commercial space is going to go. We've seen there could be challenges which may be erupting in the LRD space. There could be challenges with the total amount of rentals. The cap rates may actually go up, or the demands for yield may go up. Rentals may fall, therefore capital values may also fall. So we do see some amount of flux in the commercial side, and therefore it's hard to take a call. The easiest piece of the business has been the late stage, last mile or distress financing, where we know that there are enough and more opportunities. And now so, because, I'm inundated, Beena, with opportunities which otherwise we were not seeing pre-COVID, because people are like, hey, you know what? My business was great till February. I don't know what happened. Right. My cash flow stopped, customers couldn't come in, housing finance disbursement stopped. Labor is asking for more money, materials are looking more expensive. I don't think I can rely on internal accruals on my existing facilities anymore. I will need to shore up cash, finish these projects, monetize my assets, and get out at the soonest. That opportunity has walked in a very, very big way into our doors. So we have raised a new capital through our new fund, and that's the opportunity that we're squarely going after. Because there is tremendous opportunity. I mean, mortgage rates have been at its historic low. Disbursements have started again from housing finance companies. People do have the option of taking moratoriums on their existing loans. So I clearly believe that that's a space that we really like. We're allocating that capital to that space. And there are players who otherwise would not have come to us, who have otherwise either not taken money or taken very cheap bank capital, or willing to take this capital because they know that the time of opportunity cost is going to be much larger if they don't go ahead and finish it.
Okay, can I ask the same to Puneet? Puneet, how do you see this investor appetite? Which asset class do you see in the real estate that you would be interested in investing or?
Sure. So see, at ICICI Venture, at group level, we are actually into 4 businesses, and I will come to real estate question shortly.
Right.
So currently managing almost $2 billion of capital, and both mix of a domestic as well as international capital, right from infrastructure to special situations to private equity, which has been our traditional business and the real estate.
Right.
Now, from our perspective, see the investors' appetite both on the global and on this thing. If on a current basis, see, it is difficult to price a risk currently. But the 2 asset classes which from our focus perspective, one is continues to be affordable housing. So we have affordable housing fund. So that I resonate with Amit. That is an asset class in the whatever residential is happening or situation is happening. The only sales, because eventually you have to sell to kind of get your returns back, right? So that continues to be our focus, and we would be there.
Right.
Second, on the office side, we do believe that while we may not hit the numbers of what we had in 2019, the highest ever absorption in our country, but basically I think there's a need to go to office while the work from home is there, the business slowdown and all. But I think in the medium term, this is an asset class from ICICI Venture perspective. We do believe will continue to have an interest, both from the investor as well as from the domestic one. I think the nature of the sizes of those projects may change. So currently, if the investor appetite has been to do in a 2 million or a 3 million square feet of developments, those would move to a smaller, more city-centric, more suburb-oriented projects, because there's still a dearth of grade A office, CBD-centric or a midtown-centric kind of projects continues to be a challenge. Right. Last mile funding again would be of interest to us, and we would continue to be in that space because there's a limit to which what a government fund could do, and there's a decent demand both from the market perspective, and there would be a definite interest on the investor side also to come in and do it. There may be a mix of a debt and equity oriented structures, so there could be a debt kind of a coupon with the equity upside, which would come in terms of structures. But basically, these are the focus from our perspective.
Ambar, I'd like to come to you. The last time we spoke, you didn't sound too optimistic about the whole scenario, at least in the near term. Can you let me know your thoughts? Which asset class looks more promising from your perspective? And also a view how domestic and international investors are looking at it.
Sure. So I think I'm of a different opinion compared to both Puneet and Amit. I don't think, first of all, the next residential is going to, give you any opportunity. Okay, this is a scenario where, every single business has been impacted, and I'm not talking about real estate. I'm talking about the economy right now, where every single economist is predicting or projecting a 5% minimum contraction in the economic growth rate in India. We've faced with a situation where people are losing their jobs. People who are going to be left holding on to a job will be working at a far, far reduced salary. Buying a house is not at the top of the mind recall at this point in time for anybody. So residential for the next 12 months is likely to be a big, big challenge. Yeah. If you look at the instruments, I think debt, the high yield debt, which used to be the characteristic of residential real estate sector, is dead.
Right.
We started doing high yield residential debt way back in 2012, 2013. There was a time when residential developers used to make a very high margin. Colloquially, everybody used to say that, look, if the developer is making a 30-40% margin, then I can certainly take a slice out of that for the capital that I'm providing them at this point in time, and so on and so forth, right? So residential debt, I think, is dead. The businesses do not have any kind of margins and so forth. Okay. With this situation, given what was happening even pre-COVID, Beena, where we were in a huge amount of slowdown. If you look at the numbers, for instance, 10 years ago, India used to sell 500,000 apartments, thereabouts. Last year, we sold less than half that number. Okay. This is going to lead to a huge amount of consolidation. Players with robust balance sheets would play in this space from here on. People like Godrej, Tata's, Oberoi's of the world, and so forth, DLFs. Right? These are not the kind of guys who would take high-yielding debt from the likes of us. Okay, balance sheets are stronger, their brand names are stronger, they know how to operate in financial services markets and so on and so forth. So the era of the real estate high-yielding debt is gone. Okay. Even from an equity perspective, while Puneet and Amit both talk about affordable housing and mid-income housing and so forth, I look at credit-linked savings scheme, for instance, right? That's a good indicator of how the affordable housing is doing. And you know what? 2017, 18, and 19, the 3 years that scheme was there, all 3 years put together, only 3.3 lakh houses were sold, which availed of CLSS.
Okay.
Right? Compare that to anywhere else in the world. I mean, UK, a small island, with population probably less than a tenth of ours, sells 400,000 apartments per annum.
But Indian developers are claiming to sell a lot even during the lockdown. So do you have a different view on that? Because the sales are happening is what they're saying.
So let's define a lot. Let's define how well we're doing. Yes, compared to previous quarter, you would have sold a little bit more, but 230,000 apartments become 240,000 apartments.
Right.
Given what was happening 10 years ago. See, please understand, real estate industry started becoming organized and in the shape and form of the industry in the year 2006. Sure. Back when 2005 was the time when the government opened up FDI, right? And a whole bunch of us got into real estate industry thinking that this has the future given what's happened all over the world, right? So yes, someone would have sold 10,000 square foot, 20,000 square foot, 30,000 square foot during the lockdown, because people pre-COVID have visited sites, have done their recce and so on and so forth, and they took a decision at that point in time. But if in the year 2020 calendar year, if you're going to sell 100,000 apartments, is that doing well? Is that a lot? Is there scope for the likes of us to invest in a market where the demand has fallen by 75% in the last 10 years? I'm not too sure. Okay. I'm not so sure. And by the way, in the same breath, most of the pundits actually go out and say that, look, the likes of Godrej and Tata's and Oberoi's and DLFs, these are guys who are selling. But, these are not the guys who pay 20% IRR on debt.
Okay, I can see Puneet smiling. I think Puneet has a view on this. So, Puneet, could you tell us as to, how different do you view? And also just to add, do your IRR expectations and multiples change, in the current scenario?
See, I always smile when Ambar talks because he's a friend for 20 years now, right? So, and for that matter, every friend, there. But coming back to this, I think every crisis gives opportunities, and the opportunities may vary. So I fully resonate with the challenges in the residential sector when Ambar talks about 260,000 apartments being sold there, and they were about 80% from their peak levels. But does the India still continues to need the homes? I think the answer to that is yes. The fact of the life is that we are all taking this VC or India's your summit sitting from homes, right? So I think fundamentally the demand for homes is not going anywhere. The sector. See, if you look at while we talk about the journey from 2005, Presno to 2005, coming in, and then the FDI coming in. But in spite of that, if you look at the number of residential real estate developers in the country, I mean, every in a small micro market there are about 100 developers. Right. So the numbers are and therefore, yes, you talk about the pain in the sector, and therefore it is yes, there is a pain in the sector because finally the customer has to have a confidence. Which means first he has to have a confidence on the job, and then he has to have a confidence on the home. But I have a feeling that in this point of time, this point of time, and I say it is not really a short term, because in the short term, it is a survival. But I think moment he's come out of that survival instinct, there would be a definite tendency to get into at least a roof above the head, because at least we have seen in terms of various discussions, the way even the tenants and the owners have been behaved or have been dealt with within societies have been very different.
Right.
So, I mean, I'm a fundamental optimist, so I continue to be optimist on that mid-segment housing. The question is, would you get a 20% debt return? I think I said that earlier that, see, we were the first ones to actually start doing this structured debt way back in 2006, right? We were in mid-teens as Wells Fargo. We were the first private equity house in the country to start doing structured debt at that point of time. The mid-teens became early 20s. So I fully agree that the returns on a pure debt model may not work on these numbers, what Amber said, and therefore there could be a upswing of a hybrid structure with a debt and an equity kicker kind of structure, certain low coupon, certain high-end coupon, but there is a definite need to complete these projects. So the projects are half built, 70% built, or whatever that is, and there's a definite requirement to complete those units there. There's a demand at always a certain price point. Yeah. In this point of time, if you try to analyze demand and say, okay, 1 crore apartment being sold at 90 lakhs, would I buy it? Maybe not. 50 lakhs, would it sold at 45 lakhs, 10% reduction, would you buy it? Maybe not. You will postpone that decision. But I think at some point of time, the fundamental demand is definitely there. And at some point of time, I feel is a midterm situation.
Right. So quickly, if you could say, how much will the returns change for investors like you and for the industry?
See, we're not necessarily guided by a number, Beena. I know you kind of asked that question to me earlier. So it is not necessarily the number. It is purely opportunity driven. So whether you are getting into a last mile funding, it is a risk related to a return, right? And what stage of the project you are getting into also determines the return. So, I mean, that really would be my answer. So it is a very, very opportunity driven in terms of returns.
Amit, I think you would have a view, how will IRRs change in this scenario? It's been unprecedented.
So, Beena, to be very fair, I think the risk perception has gone up, and there are two ways to handle this risk perception. And I think rightfully so. And I think Ambar has been very vocal about the risk involved, about the uncertainty in consumption, about basic economic issues, including job securities and cash flows at the enterprise level. Now, notwithstanding that,
right,
to the extent that there are buyers available, I think there will be time to conversion. There are supply side constraints. We mentioned that. It will take longer to deliver. People will therefore need to come in more cautiously into buying these apartments. I don't think we have any doubt about that. So for that added risk, for that added uncertainty, while the outcome, I think, is still certain, the timing of that, the returns or the margins that may be available at the end of the day, and therefore the issues that may disrupt, lockdown, lock on, lock off, whatever may happen, Beena, with us, we need to factor those into our business plan. So I think in general, there is a need to provide better returns to investors.
Right.
There's no doubt. There is no need for people to put capital otherwise. So we are actually looking at almost 200 to 300 basis points of returns higher than what we would have actually done pre-COVID.
Okay.
Granted that maybe for fantastic players, I mean, absolutely, with ratings which are investment grade players, then they obviously the delta may not be that high. Sure. But for anybody who's not necessarily a grade A player, barring those 15, 20, 25, 30 players in the country that were starting to deal with still, I think there will be a delta, and it could be as high as 200 to 300 bips. And that's really the requirement. The second clearly is the fact that there needs to be a higher margin of safety, something which Rohan also alluded to. So all our transactions, all the ICs that we've had now recently have singularly said, I think we'll need more time. The projects will need more time. Let's buffer in a higher margin of safety. And let's see how much more money we can make at the end of that term. So I think both these are important. A, creating a higher risk mitigation structure. B, looking for optimizing returns. Because remember that there are multitude of investment opportunities that today the investor is going to have, whether it's in the distressed asset side, whether it's including buying distressed bonds or distressed capital market issues. There are lots of opportunities which are coming up, not only in India, but world over. So as fund managers, as investors today, it's important that we're able to create.
Amit, you'd been muted. Unmute.
So clearly, that's really where we're going to be now. I think the returns will be looking in the early 20s or late teens, early 20s for us for sure now.
Sure. So quickly, because we are running short of time, I'll just want to add one last question. You mentioned about stressed investments. going forward, will we see more stress deals given the scenario? And as your own as an investor, how do you look at it? Will you invest more? Something more concrete as to what will be the investments in that space.
So there are two types of stressed assets, Beena. One is where they will not necessarily be a haircut, but a lot of the institutions, a lot of the banking folks are willing to be subordinated. Something which wasn't happening so much till early last year. I think we see that as a fantastic opportunity. We're aggressively pursuing a pipeline where there is so much value already which has been accretive into the project because of the capital that already has gone in. But there were disruptions in the entire business plan. People thought too big, people thought too much, people thought they'll be able to do faster than what they've done. Clearly, it hasn't panned out. So by putting in a small sliver of capital, we're actually sitting on a very large capital stack. That's effectively a distressed opportunity for us. But fundamentally, there is still reasonable margins, at least for our money to make.
Any quantum you'll be looking at?
No, so I mean, I think today we're looking at least $100 million to basically go after these opportunities. The total amount of capital deployed, was very, very large. With almost about $20 billion, in through banking NBFC space, which is going to structured credit. So we're looking at a very, very small piece within that space. So clearly, that's a distressed opportunity for us. Second, we're also seeing now, of course, now IBC has stopped, right? And we may not, see new IBC cases. And that was one of the ways where people were looking to actually go into and maybe acquire those assets. But for those which are existing, and given the fact that things are going slow, I think there is a sense of desperation that is seeping into the credit committee members, into people who are actually stuck. And we're hoping for a resolution sooner than later, saying, okay, guys, can you come in and can you get this done? So while, of course, there's the SBI Swami Fund and there are other potential players in that space. But for people who are necessarily not wanting to go the NCLT route, people who don't want to stay stuck in the NCLT, they're coming us and asking us to effectively see if we can, put in the capital, bring in a third party player and have that work. That's something we're excited to.
Sure. Okay. Ambar, your thoughts on that? Stressed space at least would be looking interesting.
Okay. So developer side stress has vanished.
Okay.
There's no stress anymore.
Okay.
Nobody can take them to IBC anymore.
Okay.
The government has given out a moratorium. RBI has given out a moratorium to all the developers of the next 6 months. Okay. So the stress is gone. There is no stress. Nobody is willing to talk anymore. What Amit alluded to is exactly what will happen and will continue to happen, where a lot of NBFCs are stressed. I don't think banks are stressed anymore either, because of a variety of things that the RBI has done. The repo rates are at an all-time low. The cost of capital is so low, whereas my home loan is still at 8.5%. Right, so they're making enough margins out there. Banks are not stressed. NBFCs are stressed because they're getting, sort of force from both the sides. On the one end, the borrower says that I've given you a moratorium, and on the other end, the bank says I'm not going to give you a moratorium.
Right.
Okay, so a lot of dislocation on that end will force NBFCs to do distressed deals, but that is secondary. Beena, my problem over the last few years in real estate has been exactly this. Okay. So while on the face of it, when Jaideep presents a whole lot of numbers on private equity capital that has come into real estate, bulk of that capital has gone into lower risk completed assets. Okay, the capital has not gone into under construction or development oriented assets. Right? It's the same problem that we're facing today. That problem has not gone away.
Right.
The developer stress is just not there. My developer today, my borrower developer, or the one that was going to sell me a completed asset, pre-COVID, is now saying that, look, it is status quo. We are not talking about anything for the next 12 months. Next 12 months, I don't have to do anything. Today, I have a choice to do nothing.
Okay.
Right? Because this pandemic is a godsend.
Sure.
To almost 90% of the developers out there.
Okay.
So distress on the developer end is completely gone. Right. Which might not be a bad thing. I mean, it may impact, some businesses like mine and Amit's and Puneet's, but on an overall basis, I think for the country is a good thing. For the industry, it's a good thing. But distress, I don't think is for the next 12 months, it's gone. And after 12 months, in any case, most of the guys are going to die, and there will be a lot of consolidation and so on and so forth. So yeah, it is. These are dark times, guys.
You're being too grey about it. I don't think it's that grey and dark, my friend. It just looks dull.
I
if you
hope
get out
you're.
of the house and you move around, you'll see that the world is still existing around us,
See, I
How do
think
you that fact that
lockdown.
distress is there?
I think we have one last question from viewer. As a bullish investor, this is to Amit. As a bullish investor on residential, what is your view on inventory overhang and its impact on returns? And is there enough market control and new supply over the next 2 to 3 years?
So, Beena, yes, there is an inventory overhang. It has been there and will continue to be there. Having said that, and will take time for that inventory overhang to liquidate itself. I think there is no secret there. I think enough studies, enough numbers have been put, whether it's 1 lakh crores or how many number of units in every city. I think those numbers are very well available. So clearly that exists. Now, when you look at that in a more granular way, it could be a mispriced product, it could be a misconstructed product, it could be a product in a bad location, it could be a non-sellable product as well, or it could be a large ticket product which is really not selling. So there could be certain sort of issues with regard to that inventory itself.
Right.
Having said that, we've seen that those who had decent product. I was just talking to one of the developers yesterday. He said, if I could reduce, they went ahead in a tier 2, tier 3 market, reduced price last year by 5 to 6%, put the entire stock on bid and liquidated and cleared that inventory. So people did have the opportunity, if they were being rational enough, to sell what was saleable by doing whatever the market needed. Now clearly that market also does not exist. So there will be a pain on that side. There will be delinquencies. There will be write-offs. People will end up holding inventory, and of course, a lot of representations have been made by the industry that let's allow FDI into ready inventory. Maybe they can convert that into co-living or into some other rental asset class and maybe monetize it like that over a period of time. So that's a persisting problem. So one can't obviously sort of get stuck with the legacy issues of that inventory. What is relevant today is clearly what is required today. And let me also say that the parameters pre-COVID and post-COVID in the development space has also changed. The need for space, the need for wellness, health and safety factors, the design aspirations, a lot of the things have actually changed, and people are willing to pay more for it if they're still in the buyer market. So clearly, I think we're looking at it also from that perspective that notwithstanding the inventory, yes, if there's an inventory overhang in general in a micro market, that's not the market you want to be in. Clearly, you have to be in a micro market that works, that moves, has the right products, has the right people, and will continue to move. Bangalore has a ton of them. Pune has a few of them. Mumbai has got a few spots of them as well. So clearly, I think it is about choosing the right opportunity. And there are opportunities. And in fact, there are better opportunities today than there ever were because people are willing to consider these factors. They're willing to consider that, yes, there are elements of risk and they will need to reconfigure their spaces. They will need to reconfigure their entire approach to development. And they're willing to sort of have a more collaborative approach to development and investment. So I think we're fairly excited about the fact that today we have a more collaborative environment. We're not just capital providers and they're not just capital seekers. I think it's a more cohesive environment that we're looking to get into going forward.
Great. On that note, I think I'll have to wind up because I'm being asked to wrap up the panel. Thanks a lot for your views.
Thank you so
much. But thank you so much for your views.
Thank you.
Thank you so much, Beena.
Thanks a lot. Thanks, guys.
Thank you, Beena. Thank you so much. Welcome, Swet. Now you can take it over.
Hi. Can you hear me?
Yes, very well.
Yeah. Do we have Mike online?
Yes, we do have Mike online. Hi, Mike. If you can just unmute yourself.
We do.
Great. Amazing. We can see you well. Thanks.
Great.
Hi, Mike. Welcome.
Hello, Sarika.
So before we get into the session and start sort of asking you questions, I'll give a brief about Embassy Office Parks. As everyone knows, it's the first real estate investment trust in India. It got listed in April 2019 and it has just completed one full financial year. Talking about the portfolio of Embassy Office Parks REIT, it has a portfolio spanning across 33.3 million square feet, covering 11 office parks, 1,096 hotel keys, and a solar park. In the first full financial year, it distributed a payout of 18,821 million INR. And in the next 20 to 25 minutes, we'll try and understand from Mike how the market is likely to move for different asset classes, particularly his portfolio and the REIT market. So, hi, Mike.
Morning.
Yeah, morning. So, you've just completed one full financial year, and Embassy Office Parks being the first REIT in India. Could you tell us a little bit about the challenges that you faced and the lessons that you picked up in the first year itself?
Well, I think the positive for us is that we've had a great first year since listing. As you mentioned, we distributed that 1882 crores. That's close to 250 million US. The narrative that we spoke about pre-IPO, effectively we delivered on that with that quarterly distribution, with the revenue growth that was 15% year on year. And in fact, only yesterday I had a really gratifying conversation with one of our Bombay-based investors who holds about 30 million US in the REIT, and he was very, very complimentary towards our management team and thanked us for the total return of 25% in a market that's been quite challenging for the full year. So, of course, any business has its challenges. If you don't have the challenges, then you really don't deserve the return. But the financial year 20 really went pretty much according to plan. Very happy with the outcome. And of course, the last month or so of that financial year, we began to see the impact of the pandemic. So that kind of has changed the dynamic significantly.
So how will that change this year, given the situation that we are in? Do you think you will be able to honor your commitment towards returns, toward occupancy going forward? Because we are in a lot of uncertainty. Leasing is going to go down. There are a lot of things happening in retail. Hotels were shut for almost 3 months. What kind of challenges are you facing as a result of all of that?
Yeah, so I think it's worth going back to the beginning of this calendar year and look at where the commercial office market was at. So how did we enter this difficult phase? So our office portfolio is close to 80% is international tenant base. And in the last 12 months, people recollect that we had a record office take up across the country. I think
Sure.
Gross absorption 60 million square feet. At Embassy REIT, we actually had a record for us over the last 5 years. We leased up 2.4 million square feet. The markets that we operate in and the sub-markets there are operating at extremely low vacancy levels. So Bangalore and Pune, 4 to 5.5%. And you put those factors together and then layer on top of it the fact that even before COVID started to hit, we've seen supply starting to tail off. JLL and Cushman's reported 40% and 30% year-on-year reduction in supply in Q1. We think that's going to continue over at least a number of quarters. So that overall landscape was very favorable from a landlord perspective. And I guess that's one of the reasons that we're able to run at close to 93% occupancy. Clearly, there is going to be, in at least these 2 quarters that we're now in, there's going to be a muted demand side for office premises. And we would contend that a significant reason for that, for our type of large-scale tenant, is that their focus today is actually on their people and maintaining their business and keeping that going, that continuity, as many of them work from home, and then figuring out their strategy only after they've been through this phase. So we've spoken to a number of our occupiers who are saying the strategic decisions about, do they need more space? Do they need the same? Do they need less? Do they need to reconfigure it? Those types of strategic decisions will likely be taken after the storm, so to speak. You don't stop dealing with the challenges of today in order to create a strategy for tomorrow when the whole environment is so uncertain. So we're dealing with our business and our tenants in the normal fashion. We're very closely connected with our tenants on a daily basis across the country. I think this week there's about 15,000 people working in the parks, over 170 companies. So that back to work process has started, albeit slowly, and it will be slow, and that's to be expected, because people are taking great care about the safety of their people. And a lot of that rigor actually is coming from overseas HQs to the international companies that operate in India. And so they, and in fact we, are working to the same international protocols that would be put in place in Europe or the US. There's plenty of challenges in the business, in the good times and in the challenging times. And we just knuckle down and deal with those.
Right, interesting. You just mentioned about 25% returns. Could you give us a breakup of that? How are you calculating it? And if so, if the returns are so good, why is it not so popular among domestic investors? What are you looking at to sort of make it more lucrative and attractive for domestic investors to look at REIT?
Yeah, so I mean, I think we always talk about the REIT model in India as being a total return story, so that we're delivering up those quarterly distributions. I think based on our listing price, the yield on distributions was about 8% for the last financial year. So an investor is able to look at that and compare that with the sort of dividends that one might be getting from, certainly, you know, in the real estate sector, there's really nothing that compares in terms of distributions. You know, if you look at the top 10 listed real estate players and you total the distributions that they paid last year, our distributions are probably 50% more than that combined total, that 1882 crores that we delivered. So that quarterly distribution is one piece of the total return story. And then, of course, as your rental growth continues, as your portfolio scales, then the underlying value, the NAV of your portfolio is increasing, and that gets reflected directly in the unit price, which you can trade at a premium or a discount to NAV. But that's the second piece of the total return story. So for last year, when we talk about a 25% total return, broadly speaking, we're talking about approximately, I think it was 16.9% on the unit price and approximately 8% on the quarterly distribution. Once people unpack the logic of the REIT model, the REIT regulations that have been put in place by SEBI, which I believe, and I've said this from day one, SEBI have done a really good job in putting together regulations that in a balanced way protect the interests of all unit holders, has strong governance. They looked to the Singapore model. In some senses, they copied and pasted it, made some modifications for this market, reduced some of the areas of risk that one might often see in listed property companies. So we're limited to the quantum of development that we can do, 20% maximum in the portfolio. And that, of course, increases by reducing the risks that you have around development. You're effectively increasing the predictability of the business. So that and a number of other issues around independent directors and governance means that the REIT, although it's new to the market, I think now domestic investors, they've seen 4 quarters of delivery on the distribution. There are still, I mean, we have, I think it's over 5,500 domestic unit holders. I referred to one of them earlier on, and that's increased consistently over the year since IPO. I think the appeal of the REIT is Can we just ask Maliak?
Yeah, can somebody ask him to mute his?
Yes, yes. We'll
Wait,
just
can
take
you
care of
ask?
it.
Yeah.
Yes, we'll just take care of it.
So I think what's going to happen, and then there's also an increasing awareness of a number of the benefits around a REIT, not just the underlying business model, but the fact that dividends that comes out in the distribution is tax-free for domestic investors. And when we have a marginal tax rate at 43% for other forms of investment, that is another appeal of the REIT model. So we think that we are the first. I think we're very happy with where we ended up our first year. We're very transparent about what the portfolio is, and details around that are all on our website, high levels of disclosure. And we think that, like the gentleman I spoke to yesterday, who was very positive about his investment, we think that there will be increasing numbers of domestic investors, both institutional and individuals, over the coming months and years. It's a very clear, transparent, understandable product.
Right, understood. But the market is kind of obviously bad. But when you compare with other listed developers, they are in a different category. They are mostly, barring a few here and there, mostly focused on residential real estate market, and there is a lot of development risk. Your portfolio is 80% complete, so the development risk is very different. The profile is very different from what you see in the listed developer. That's a different category. So except one or two here and there, do you think the comparison with maybe the listed developer is kind of is misplaced and shouldn't be taken as a metric?
I think that it's valid to look at that because people understand real estate as one homogeneous investment sector, and so to help people to understand how that breaks down and the different elements of risk in different sectors. The fact that, the difference between a trader developer and a developer investor. So am I going to develop and hold, which is what we do with our on-campus development? Am I developing to trade? Am I in a different sector like residential? I think people need to understand the different sectors and the different risks that are there about them. But even frankly, if we were to compare ourselves with the Nifty 50, our performance last year was significantly ahead of the Nifty 50 index. Pretty much, there's just a number of indexes worldwide and domestically that in a very volatile market, particularly in the last quarter, the Embassy REIT has performed extremely well. So you can compare it against real estate, you can compare it against a Nifty 50 type of companies. It doesn't take away from it's a solid business model, super strong balance sheet, and that's going to help us should we look ahead at acquisitions.
Sure, understood that. Also talking about other REITs, I mean, the first REIT happened after a lot of effort from developer community, from the government, regulations, and all of those things put together. Do you think the market is kind of bad right now, and the way real estate is kind of impacted different segments of the market? When can we see next REIT? Or is it going to happen in near future? That does not look possible. What are your thoughts on that?
So my first thought, Sarika, is that, some aspects of the market that I see in the commercial real estate sector are not so bad, to use your words. The technology sector is the one sector that through this pandemic, domestically and internationally, has continued to prosper. Whether you look at the Dow Jones and see where the technology firms sit in their performance, or whether you look at some of the domestic companies here in India. And the technology sector is the foundation of the commercial office market in India.
Right.
So a full 50% of our portfolio are with core technology companies, global names like the Googles and Microsofts and Facebooks of the world, and also some of the best domestic names. So technology is really, in many areas, doing very well all around the world. And the potential, and you know, one can speculate that, I think Rohan Sikri spoke earlier on about the post-GFC employment boom or growth that happened as a result of banking sector putting more work into India. It's quite conceivable. In fact, you know, you could speculate that it's quite reasonable to say that you might well see increasing jobs and therefore employment and therefore office demand in the tech sector once the market starts to recover in a broader sense. So, you know, there are plenty of sectors that have done well through this this difficult period. There are stressed businesses, of course, and we have a small proportion of stressed businesses within our portfolio, and we're working with them to see how can we get through this together. But the fact that in April and May we've collected 92 to 95% of our overall rentals, I think is a reflection of the fact that our occupiers are continuing to do their business, whether that be in the office or whether that be in the business continuity work from home environment. So you know, all is not gloom and doom. And my friend Amber earlier on put a fairly negative spin on it. You know, there are positive lights, but it is a very uncertain time, uncertain period. And India in particular, I've seen it myself, has a great resilience and ability to bounce back.
Mm-hmm. Right. Okay, understood. But what happens? I mean, from what I understand, you are going to look at on-campus development and also going to look at you know, acquisition from your partner, embassy, and also outside of that, you know, acquisitions from market. What kind of activities can we expect from embassy office parks in the next few quarters? Are you going to look at some acquisitions because valuations are going to be attractive? There is a lot of uncertainty in the market, gloom and doom, and therefore you can you know, make use of that opportunity.
Well, so two things. The on-campus development, I think we, you know, we're fortunate that we just delivered end of last year the 1.4 million square feet of new on-campus development that was underway in Bangalore and in Noida. Again, we pre-leased that 62%, I think, of those properties that were delivered. We don't have any new on-campus development programmed for another couple of years. So there's really negligible impact from our perspective around the inevitable delays that will come into the market because of the labor and liquidity that's well recorded and reported. And that actually, that reminds me of this issue of supply. I mentioned how supply has in Q1 really started to fall. It's going to fall further. And that, for landlords like us, it is actually clearly a positive. And it's a very different scenario to what happened under the GFC. You know, in the GFC days in 2009, 10, 11, we were still seeing a wave of supply coming on through, which right. Even though demand was increasing, that muted rental growth. So it's quite conceivable that we see a situation where there'll be, you know, with a very low vacancy in certain markets. We're going to have less and less supply. We believe that the technology sector is going to continue to be, you know, India is, there's no getting away from it. India is the #1 technology provider to the world because of the people who are here. And the world is just getting more complex and more fixated around technology. So in the medium term, by that I mean early next year, we could see a situation where that limited supply and that demand coming back could actually end up in a pretty positive position for people like us, the leading, say, top 10 developer owners. In terms of acquisitions, yes, we're looking at a number of acquisitions. We will make sure that they're accretive in a qualitative and quantitative sense. We're looking for synergies with our existing portfolio in terms of the tenant base. We probably want to focus on properties that are large scale, and we can create that, we call it that total business ecosystem that provides all sorts of amenities to our corporate occupiers, not just office space. And again, I think that's one of the reasons why people want to be back in the office. That young demographic that's working particularly in the tech sector. One business leader said to me, the office is their home, because that's where they come for breakfast, lunch and dinner. That's where they have all their friendships. That's where they build their career. They do their learning, their networking, where they take on board the company culture, which was what the CEOs of both Infosys and Microsoft were saying the other day. There are so many attractions and for the companies to be in that complete business ecosystem. So we'll do acquisitions if they're accretive, qualitative and quantitative.
Sure. So a couple of last questions, Mike. You briefly mentioned about, stressed part in your portfolio. You have over 2,000 keys in your portfolio from hotel segment. They were shut, completely shut for 2-3 months. What are you doing to sort of, take care of challenge in the hospitality and hotel segment in your portfolio, and what do you see generally in the market?
Yeah, I mean, actually, I think we report that we have approximately 1,600 keys, but about half of those are under development. We're developing a Hilton and a Hilton Garden Inn at the front of Manyata. That's still under construction. It's approximately 18 months away from completion. And that, again, is part of that total business ecosystem. We do have 2 operating hotels, one at Golf Links and one at Embassy One. And again, the philosophy there is that they support the office environment around them. And yes, we expect them to reopen shortly. They account for less than 3% of NOI, I believe, less than 1% of distributions. So we will work hard to get them back to business, but it's a very small proportion of our overall portfolio. 92% of our portfolio is core business park office.
Okay. Just one last question in terms of what kind of conversations are you having with your tenants and occupiers, and how has that evolved over the last few months? If you can share some insights from there, so as people can understand what kind of concerns tenants and occupiers, companies have in terms of their space requirement, rentals, and their outlook for the next few quarters.
Yeah. Okay. So very quickly. So we obviously, and I think any good landlord, like many good landlords in the country, have a close dialogue with their customer. We were doing that before the pandemic. We accelerated that through this pandemic period, where we are having an engagement on a daily basis in a written form with over 1,000 of our occupier representatives. And also at least once a week on a verbal face-to-face basis with those tenants. So what we're hearing through the pandemic is obviously the focus is on business continuity. So we've been helping our occupiers with achieving that work from home in any way that they've asked us to. I won't go into multiple examples, but we've been talking to them about the work from home conversation, what it means for them, how's it working, and so on. And we've had a lot of insights around that. We understand. So my comment earlier on about people will get through this storm and then move to strategy, that's the sort of conversation that's come from tenants, and they've told us that. I think everybody at an occupier level is, as you suggest, focused on their people and the health and safety side of their people. And I just want to underline the fact that I was reading a Bank of America report yesterday, And in that report, it put a table of occupiers from IT, banking, BFSI services. And it showed the percentage of rental as a percentage of total cost between 2 and 8% for different industries, different companies, and so on. 2 to 8%. And in the IT sector, the percentage of cost from an employee basis was, from memory, about 58% to 74% for the big Indian IT companies. And that kind of sums it up. Where are people focused? They're focused on their people. And if the business is a business that's prospering, they will continue to look for good quality office with good governance, good standards around safety, hygiene, and so on. And that was the case, and I think is even more so the case now going forward. So
Sure.
the larger companies are focused more on the qualitative aspect of their office environment than chipping away at a couple of rupees here and there. But there are some stressed companies and stressed sectors. They tend to be the smaller scale, more domestic focused companies. And we'll have to work that through with them. And some of them will not survive, I'm sure. But the basis of the Indian office sector, the tech sector, we believe there's a good current and a good future for that. And therefore, that's good for the industry and good for Embassy REIT.
Cool. Okay. Interesting, Mike. That brings us to the close of the conversation. And thank you so much for your time and your insights. I'll now ask the host of the introduce us to the next set of panelists. Thank you so much. Thanks much, Mike, for your time. Thank you. It was nice chatting.
Thanks, Rohit. Thank you so much.
Bye-bye. Okay, so are we all set for the next session?
Yes, we all are in.
I know we are running late. Let's get started.
Yes.
Please unmute him and put him on video. Shwet, you can please start.
Okay, can I see my panelist? I should be joined by Abhijit.
Yep.
Malkani. Hi, Abhijit. Welcome. Anshul Singhal. Hi, Anshul. Welcome.
Hi.
Hi, Murli. Hi.
Good morning.
Yeah,
Morning.
these people need no introduction, but I'll still introduce them. Murli is the CEO of Shriram Properties, Chairman and Managing Director. Abhijit is the co-CEO of ESR India, and Anshul Singhal is founder and Managing Director of Wellspun One Logistics Parks. In the next 20 to 25 minutes, we'll try and understand from them what's happening in residential real estate market and warehousing, which is emerging as a strong asset class in India. I'll start with you, Murli, and try and understand from you. A lot of politicians have said to the industry bodies and to the developers that they should drop prices and sell. That's the only way to survive. Do you think you as a developer or the industry is ready to do that and accept that suggestion, or are you fighting back?
Definitely, I disagree with them, whatever they have mentioned. While on this, there is some merit in what they are saying. Unfortunately, we are trying to give paracetamol for corona, diabetes, liver cancer, all kind of diseases. We are giving one medicine, which will not work. So India has grown today. India is a very different nation altogether. Each state, each city functions or reacts to a very different situation. Hence, we need to apply different medicines for different problems. We cannot apply medicine for a problem in Bombay to Chennai. We cannot apply the medicine what is suitable for Bangalore to Delhi. See, India is well diversified today. The problems are also very, very different. If you let's take a deep dive into it. If you look at most of the bankers and some of the senior most people in the country. For them, real estate is Bombay. For them, real estate is Delhi. We need to get out of that. India is not Bombay and Delhi. 40% of GDP comes out of South India. So we need to look at how each city behaves. If you look at luxury segment across the country, which is going through some trouble, I don't know whether discount is a solution for luxury segment. Maybe that is a solution. I don't know whether 20% discount or 10% discount or 5% discount. I don't know what is the solution for that. But there is no, the problem is still yet to be addressed. Whereas if you come to the most needed affordable housing segment today in the entire country, if you come to South India, Bangalore, Chennai, Hyderabad, and part of eastern part of India, maybe Calcutta if you take, these four cities, the supply of affordable housing is very, very limited, whereas the demand is very, very high. If you look at all the senior developers in these markets, they have practically zero unsold inventory on affordable housing. Hence, there is no question of reducing the price. Also, there is no scope for them to reduce the price. So maybe the same set of developers, they may be stuck with some stock in luxury segment. Hence, that needs a different solution. If they have a portfolio of retail, if they have a portfolio of hotels, that needs a different solution. You cannot bring real estate under one today and try to get solution. And let's also look at housing for all agenda. That does not talk about luxury housing for all for entire country of 138 crore people. It talks about housing for the needy, housing for the people. We forget, we talk so much about migrant laborers. We forget to talk about migrant employees in migrant white collar jobs today. Plenty. If you take any city today, whether it's Bangalore or Chennai, Hyderabad, Bombay, Pune, any city, more than 60% people have moved from other places. They need first time homes. And for them today, there is very, very little supply available. Let's come to now Bombay and MMR region, Pune and all that. Again, affordable housing. There is a lesser supply, higher demand today. And unsold inventory of this stock is very, very limited from the top 10, top 20 developers. NCR market is very, very different. We cannot apply NCR logic to anything else today. So we need to dissect the entire real estate into several aspects. Affordable is one, luxury is one, hospitality is one. Sometime back we talked about office space is one. Retail is another one. We need to dissect the real estate and try to give a solution. It's not only dissecting the verticals in the real estate field, you should also dissect into the city wise. Each city behaves its own way. Hence, whatever they have said, there is some meaning in some section of the country. It is not applicable. Whether it has been going in social media, what Mr. Deepak Parekh said, or what Mr. Piyush Goyal said, what Mr. Uday Kotak said. Probably, they all looked at from their point of view, wherever they have pain points. Maybe HDFC has some pain points which they try to address. I don't know, Kotak might have some pain points they must have tried to address. But let us look at the pain points of the common man. Let us look at the pain points of the public here.
So you were saying that their thoughts and opinions are misplaced.
Absolute misleading, or probably it is not, sentence is not complete. Probably they should have added something different.
Why don't you complete the sentence?
Yeah, this is not applicable to Chennai, this is not applicable to Bangalore, this is not applicable to Hyderabad, this is not applicable to Thane, this is not applicable to Pune, this is not applicable to Calcutta on affordable housing. Hence, I would encourage, probably if I have to make a statement, I have to complete the sentence, I would say all affordable housing players in this country, in this market, please go and get ready for 10% to 15% price increase. All the buyers, beware. The prices are likely to go up in affordable housing in the cities. Now come to luxury segment. People who are in the luxury side, find a solution. By giving 3 months moratorium or 6 months moratorium is not going to give a solution because demand is not available today. Neither, what Mr. Piyush Goyal said, demand is unlikely to be generated in the next 3 to 6 months time. Where? On luxury segment. Affordable, there is excessive demand today, we are not able to supply. On the other hand, economic layer section, practically zero supply, which is what government is supposed to address, whereas demand is piled up for the last 20 years, it's not addressed yet. So we need to dissect this and see. This is what I would complete the sentence stating that, yes, these are all the areas, prices are going up. As we speak, We have launched a project during this lockdown. We are launching this quarter, which means first quarter, another 2 projects, which means practically we have launched 3 projects in this first quarter during this period. We have increased the price by 5%. We wanted to increase by 10%, but my sales team said, wait for the second quarter, we'll increase the price. We are increasing the price on affordable housing by 10% in the first 2 quarters. That's a reality today. While people talk about price reduction, which I don't subscribe, on affordable housing today.
That's being very optimistic, Murli, I must say. I'll move to Abhijit and try and understand from him what he sees in warehousing segment. It's an asset class that's doing really well. People have, a lot of shopping is moving online. That trend was anyway there, and it's getting further cemented. What kind of opportunities do you see in warehousing? Do you think it's a good time to be in that space, and there's going to be good and attractive opportunities there?
Yeah, no, sure. Yeah. Appreciate this. I mean, it's quite interesting to see everybody's view on the gloom and doom kind of a situation. I think I'm a little more optimistic than people around here. But surely, to understand the warehousing situation, the warehousing and industrial situation, like I said earlier, it's short-term pain. It is short-term pain and long-term gain. Of course, the short-term pain is a lot. It is quite painful. But I think overall, looking at what's going to happen in the warehousing sector as well as the industrial sector, we see that we would see that as one of the. I mean, obviously, it's not been insulated. Obviously, this whole situation has hurt it bad, but we see a long-term. We see a lot of long-term growth in that sector. I think to go back, I want to go back about a few years. I think the growth of warehousing and industrial started about 2 to 3 years ago. Approximately 3 years ago, after GST, after all the GST reforms, after all the, GST, after all the tax reforms, after the whole consolidation process, 3PLs coming in, e-commerce, the increase of e-commerce in India. I think that's where the real growth started. So we came into the COVID situation with a strong pipeline, with high requirement demands. Obviously, very, very challenging yet, but we came in that situation much stronger. So I think as compared to some of the asset classes, that was one of the difference that you would see. In terms of the warehousing sector, I think one of the big things for us has been the e-commerce. Has been e-commerce. There's been exponential growth in the e-commerce sector. So we are seeing increase in demand in that sector. We are seeing increase in demand in the food business, in the cold storage business, in the pharmaceutical business. So there are certain sections that will continue to drive the growth, the actual growth out there. On the supply side, I think that's one of the opportunity for some of the institutional players. Due to the COVID situation, I think quite a few people have talked about delays of 2 months, 3 months. I think I'm not that optimistic here. I think the delays are about 6 months because of construction issues, labor issues, construction issues, and also materials. There are not too much materials available like concrete and sand. So that has actually created a lot of. We have started off. We're about 9 sites that have already started construction, but we are not full steam. We must be about 40%. There. So that will take a little time. So I think supply side, like I said, it's a big opportunity for us. Supply will go down. Demand side will grow. It will grow. It will exponentially grow in the next 6 to 8 months. 6 to 8 months. I think the industrial side will take a little time. I think industrial side will take another 6 to 8 months to start seeing the auto manufacturing and other components really start off.
Sure.
I have a very optimistic view on what Abhijit said on warehousing side. We have large asset in Calcutta Township. We have a space for warehousing. Before COVID lockdown, there were about 3 people on the table discussing on a joint development. Now, during this last 1 month time, 2 of them turned out to come back to buy the asset and develop it. It's a large asset, 60 acres land. People are talking about developing warehousing. See, suddenly the new again, they tied up with a new investor. It's a sovereign fund. they are looking at now buying the asset today. So people are also looking at opportunity today, how to lock in the asset at a good value for a long-term one. So I hold a very, whatever Abhijit said, very optimistic view. I also hold along with it.
Sure, understood. I'll take that point further, Anshul, and try and understand from you. You just launched a company a few months back, and the market is hit by this corona situation. Are you sort of disappointed, or are you sort of happy that you're going to find good deals in the market, and you can sort of strike deals at good valuations at good price? What's your sense there? You're on mute.
Common problem. Thank you. Yeah. So I'll start off by telling Mr. Maliappan, I would also be interested in looking at your land, sir. So please let us know. We'll get
some deals happening here.
We'll get in touch with you right after.
We are already in discussion with him.
No, so on the fact that we started Wellspun 1 in December, and really we started One Industrial Spaces in July 1, which has been exactly 1 year. Within a year, we've managed to get a good backing from Wellspun Group. Wellspun Group is a $2.7 billion organization. We are the only platform in India which is backed by an industrial house, a large industrial house, and because this is industrial real estate, that comes with a lot of synergies. We are actually, whether I'm happy or sad, I don't know, it's hard to say, but some of the best teams in the world were formed during difficult times, like including the likes of IBM, and I can give you a whole list. The beauty has been we continued hiring, we continued building. In December 1, we were 5 people. Today, we are close to 30 people, we have a complete platform in place. We have a large asset in Bhiwandi, which is about 3 million square feet, which is one of the most difficult markets in India to do warehousing in. So we are actually very positive about the growth. We do not have legacy problems. We do not have operational sites. So we do not have to really worry about delays, construction delays, cost of holding money, cost of holding labor. So that puts us in a very unique position. Also, we have enough capital to deploy in terms of buying land, doing joint ventures, joint developments. And what we offer is a little bit of a different model, is development management. So from Wellspun 1 perspective, we, I think, are in a very good place when it comes to the timing of our business. A little, if I can talk a minute or two about taking forward from what Abhijit said on the COVID situation, my views on that. So if that's okay, there's really 3 things that boils down to what's happening in the warehousing space post-COVID. And I'll quickly touch upon these 3 things. I know we're short on time. So number 1, is really internet penetration, which is driving for the warehousing growth. Number 2 is your acceleration of what was already happening, right? And number 3 is really a change in buying, is sector preparedness, right? All of these 3 things Abhijit touched, but just look at warehousing as a sector. We've had $6 billion, which was announced in the last few years, which is good, high quality institutional capital, including, Abhijit, who's one of the leaders in the space here, chasing this space. So that's high quality institutional $6 billion. What does that mean? That means no NBFCs, no NPAs, no mounting debts like the residential sector, right? Very, very low vacancy. Warehouses can be delivered in 6 to 9 months, 12 months. So very low construction cycle, which means very low credit risk, right? To top it all, we've had very favorable policies like GST. We've had 100% FDI allowance in warehousing. So if you put all this ready, we are prepared as a sector. Now you can have a great opportunity in front of you, but as long as if you're not prepared to bounce on that opportunity, then it's going to be very difficult to be able to capture that opportunity. So warehousing sector, unlike many other sectors in real estate, has been well prepared. The sector preparedness is high. Now, in the last 4 months, the internet penetration, which is my point number 2, has gone up by 24%. So India had an active internet user base of about 570 million users pre-COVID. Now we are at 670 million, right? That growth would have taken India 5 years to get to. So because the active internet users have gone up by close to 70 million in a very, very short window, what that does for a company or a very important customer like an Amazon or a Grofers or a Big Basket or a First Cry is their active users go up very quickly. What that does is it increases the space for warehousing demand. As Abhijit rightly pointed out, that in the next 6 months are going to be bad for everybody, right? So it's going to be slow. But having said that, what's going to happen in the next 6 months, supply is also going to be less, right? Now, demand and supply is a simple calculation. The minute the supply is less and demand is now rising because of active e-commerce, you're going to have hopefully a slight upswing in rentals, right? Because the space for demand is going to increase. There's going to be migrant labor issues, there's going to be labor issues, material issues. That's short term. But luckily, our sites are not in city centers. Our sites are away from city centers. So, being able to, if you can find good accommodation and safe practices, you should be able to deliver quality supply, especially for players like ESR, Wellspun One, Indo Spaces and us, and so on, which are organized companies. So if you combine these three things, there's a big buying behavior change. The first reaction now is I go online. I don't want to go to a mall. I don't want to go shop and try on a shirt, right? I want to go online. So effectively, my computer window is replacing my shop window.
Sure.
And my warehousing space is replacing my shelf space. So if you put these three things together, the next 2021 year for warehousing is looking very good. Obviously, 2020, there are going to be short-term gains.
Sure.
Like what Abhijit said.
Sure. Muli, I'll try and understand from you. I mean, there has been a lot of demand from developer body to the government. I mean, CREDAI has written letter stating 10 things that they want the government to look at, and there have been other such demands. What is needed exactly from the government? A lot, I mean, some part has been done in terms of moratorium and interest rate and IBC and all those things. What are the 3-4 things that you think are needed to sort of take the industry to on the right track?
The first and foremost thing I would ask the government, not some small moratorium here and there, 1 month buffer or some amendment here and all that. No. Now today we have reached a stage. This country has reached a stage. Forget real estate for the time being. Forget any specific industry for the time being. The country has reached a stage. India has been built on 4 pillars: bureaucracy, politics, politicians or political network, judiciary, and media. Now there is a time which has come to add the 5th pillar, business. The people who create, who create wealth for this country, they need to be trusted first. How do we do this? How do we implement it? Today, this British has created about 100 years ago this trust amongst the people who could create wealth so that they could, if they can start supporting the freedom movement. That will hurt them. Hence, they created the documentation in such a way, control mechanism in such a way that businessmen were seen as a criminal and crooks. So the wealth was not allowed to be created in this nation. That was a mistake British has done. Last 7 years, we are building the same mistake. Recently, Pandemic Act has been amended. 1847 Act has been amended. We should be amended 1847. Scrap this act. You create a new act. Now, 5th pillar to be created is what I would say. What we should demand, all the business community should demand from the government is as follows. Trust us first. That's very important. How you trust media, how you trust politicians, how you trust bureaucracy, how you trust, judiciary, same level of trust you do it. Which means next 3 years, give a holiday to all the governing authorities, all the regulatory authorities, give a holiday for 3 years or 5 years. Remove, all the development authorities, all the regulatory authorities, all income tax authorities. Give them clearly define the framework and say that within this parameter, you keep functioning for the next 5 years. Will not ask any question. No ED will come to you. No, I'm not saying all the businessmen will do right thing. I am sure there will also be some wrong people. There will also be 10%, 20%, 30 people, maybe as good as wrong people in the other 4 pillars. So that will be the situation. I would say probably because now you are giving freedom first, maybe less number of wrong set of people compared to the other 4 pillars to start with. It will take some more time for this to decay. So we need to start trusting. I'll give one example. Government of India has announced 300,000 crores of support to MSMEs, and which is a very genuine attempt by Government of India. I believe the highest office has been chasing the banks to disburse. I have been talking to various bankers. Today, they went ahead in disbursing sanction letters on SMEs who are borrowing less than 25 crore limit. The bankers are saying the success rate is less than 10% today, which means there is no fight in those businessmen to do business. So how do you address that? See, by giving moratorium and all that, it's like giving painkiller. Painkiller is not the solution. You need to correct your stem. You need to make sure that your body is fully balanced. That can happen only by trusting people. We need to trust the wealth creators. That's very, very important. Today there is a distrust. I will not say there is a distrust. Distrust from both sides. Businessmen do not trust government. Government do not trust businessmen. It is time has come now. I would say all the industry bodies should not keep asking small little things. They should ask one shot next 3 years. Then I can tell you we can beat China on their knees down. That's a possibility. We can become 5 trillion economy in the next 3 years time or 2 years time much faster than we expect. Then we can once address your spinal issue, then we can talk about whether we need to put some ointment here or some ointment there. Then that's the easier one. Otherwise, this small little medicine is not going to help. So time has come for complete transformational change we need to bring in.
Sure.
CREDAI can keep on asking, CA can keep on asking. I don't think it will give solution. It may give solution for maybe 5% of the people. Again, there are vested interests. Everywhere there are vested interests. So I don't think that's a solution is my view.
Good insights there, Murli. Abhijit, what happens to supply in warehousing? I mean, obviously that is disrupted because of the labor issue, liquidity issue, and the supply chain overall is disrupted, and you can't acquire much in warehousing segment because, like we discussed some time back, there aren't many opportunities that you can look at from acquisition perspectives. So, do you think what happens to supply side? Well, there is demand, and that's going to increase with time, but will supply be able to keep up with that?
See, first of all, if you ask me, I think Class A is the new norm. I think very, very clear, using the tech, using the recent terminologies, about. So Class A is going to be the new norm, I think, going forward, because with the new kind of technology that is needed to run warehousing, after this whole pandemic thing, warehousing will change, that the structures will change. People are not now, people need good warehousing, good quality, warehouses. People will like I said, the racking systems will change up, technology will change. We ourselves have changed, we ourselves have actually launched an ESR app, which runs the entire infrastructure, which actually runs the entire infra part of the business through the app. So your phone runs the entire, infra part. So I think looking at all this with Class A being the new norm, the supply side on Class A is going to be low. It was anyway low. There was still a gap between good quality demand, supply for Class A space. So yeah, and also what's happened in the last 3-4 years is it's not only the institutional players who are actually building Class A. It is also some of the local developers have started to improve their quality. So what's going to happen is because of lack of capital, lack of labor, you are going to see a shortfall in supply for the next at least 2 to 3 quarters. Supply will come down. So that, as I said, will be a big opportunity for players who have the capital, who have the land, who already have the approvals, have also been able to sit down and work a good strategy in terms of labor, construction. They've been able to talk to their contractors. They've been able to get the right structures on site. I think that is the big opportunity. So I think on the supply side, like I said, it's not a 2 months or a 3 months off. It's about a 6 months to 9 months delay in terms of that. So which is where we ourselves, ESR and some of the other players also, and Anshul also said, that a lot of companies, a lot of the local developers have already started reaching out to us to be able to either collaborate with us, partner with us, or sell with us, because there are a lot of projects that have been signed up, but they are not able to start construction or they're not able to go forward So you will see a change. You will see a change there. You'll see a lot of large institutional players coming and helping the local developers fill out that gap between supply and
Sure,
requirement.
understood. Anshul, I'll try and understand from you. What is the kind of equation you've seen between, let's say, a grade A player and the unorganized market? That space and the equation has evolved over the years, right? How is it now? What percentage of the market is kind of dominated by grade A players? What's the equation like? How rentals have moved? Can you give me some sense there? What's happening? Let's say, because Abhijit was telling me that a lot of local players have also started sort of upgraded themselves and started building better and more efficient parks. So what's happening there? What's the gap like in terms of rentals and share of market?
Yeah, it's a good question. So basically, if you see the last, as Abhijit rightly said, in the last 3-4 years is when this is really all blown up. In terms of warehousing becoming a very important asset class. Globally, this was always there, right? So if you look at the US or Europe or Hong Kong or Japan, it's already very matured markets. Now, even in such matured markets, there is some insane demand which is coming up post-COVID. So US, Amazon alone has hired 175,000 workers. India, Amazon is hiring 50,000 workers. Why am I saying all this? Is to answer your question, unorganized local developers, as everybody thinks a warehouse is very easy to build. I can build a warehouse in 6 months. Arey, warehousing mein kya hai yaar? Fatafat wo, PB लाएंगे और वो खड़ा हो जाएगा. But it's not that simple a business. When you talk to customers and when you actually try to solve an Amazon's requirement or a Flipkart's requirement or a DHL's requirement, they're fairly technically engaged buildings, fairly advanced buildings. Now the problem is the Superman mentality, which is there in a lot of new trying to upcoming developers who haven't done this before. They quickly begin to realize that once they get into deep, and these are smart guys, I'm not ridiculing them, they quickly begin to realize that we need help, we need support, we need advice, we need guidance. We have capital, we have land, but we honestly don't understand this business. And it's not as simple as this guy told me that I can put up a warehouse in no time. And that's when they would start approaching us. They would start talking to us. And while they are talking to us, they come to the conclusion that, it's better just to partner, right? It's better to join hands, and two are better than one. So over the last few years, we've seen a lot of local developers or people who have landowners, family offices who have partnered with the likes of, the institutional players like ESR, Wellspun, and so on. So you're going to continue seeing that trend. Now what's happening post-COVID is that's accelerating. The other thing that's happening in the last 15 to 20 days or 30 days that we are seeing deal flow is the price expectation of landlords is becoming more, curtailed or more realistic would be the better word, right? So he knows my land is going to sell for 1.5 crores an acre or 1 crore an acre or 1.2 crores an acre, but the starting was some crazy number, right? Now, because of COVID, I don't think there's been a correction in terms of a very deep correction in the market, because these are already non-city center lands. But the starting point is more realistic, where you can start discussing numbers. They're more open to JVs. They're more open to realistic price expectations. So that's the difference I've seen. As far as delivering grade A quality, as I said, it's a complicated product when you get inside it. It's easy. Local developers have upped their game. Definitely, they've upped their game significantly. Some of them are really, really good, almost the same as any institutional players. But at the same time, saying grade A and delivering grade A are two very different things, right? In my brochure, I can always write all the specs and say I'm giving grade A, but can I actually deliver it is where it's not happening, and customers know that difference. So that's
sure, understood. On the residential side, Murli, you sound very optimistic and positive. That's a good thing. But can you help us understand, what kind of numbers did you clock in the first 5 months of this calendar year compared to the same period last year? That will give us a sense as to how the market is moving. Just give like a rough estimate.
See, last year we did about 3.3 million square foot pre-sale. In the last quarter, I think it was close to about 1 million square feet in the last quarter. During the lockdown period, there was nothing open until end of May. We sold about 350 units, which is roughly about 3.5 to 4 lakh square feet as on date now. So we hope to finish this quarter with about 6 lakh.
So you were saying 350 unit in the first few months of this year?
No, first 2 months of this financial year.
Okay. Okay.
So 5 months if we take, it's about 1.3 million square feet approximately.
Mm-hmm.
So
what was it like? What was it like last year?
I mean, these first 2 months. I mean, last quarter of this financial year, Jan, Feb, March, we haven't lost much. Last 10 days was the dampener because 24th was lockdown.
Sure.
Unfortunately, we launched some projects on March 7th and 22nd, which did not get a necessary attraction. Sure. Otherwise, we were more or less there, about 85% we were there for the first quarter of this calendar year.
Generally, what percentage of the usual sales that people are able to clock in this market? Because there is one section that's saying we have clocked, this kind of sales number, we have sold this much unit here and there. We see so many reports. On the other hand, the developer and the industry body is seeking for, n number of demand and help. So one is not able to wrap, sort of head around it. So what's your sense? What kind of sales number are we going to see this year?
In the Q4 financial year, as I said, it's not 100% we have done. We have done 85%. There is a loss of 15% due to lockdown. In Q1, this financial year now, in the last 2 months' time as we speak today, we have done only about 35-40%. That's to that extent, it's a loss. Hence, there are some support system is required, like interest moratorium, which is a must. For any type of affordable housing or because now migrant labor, they are not coming back yet. It will take time. Sure. There is interest subsidy. Interest moratorium is one thing which is required. The approval delays, which has to be removed completely, regulatory bodies to remove that. Then there has to be free platform for people to do it. Then various other infrastructure support which is required. So those are all the areas for affordable housing is needed. Then GST, there is some demand on GST, which is unwanted. So there is no input credit available. That has to be provided immediately. Stamp duty, which is one of the highest, and it is not supporting the rental income or investor market. So that has to be supported. So there are quite a lot of small little items which will help government to enhance their revenues today. Currently, they are also choked, but they also need to get more revenues. Rather than opening liquor shops, they can open, they can reduce the stamp duty, which can give them much higher revenue today. So that's where I think governments have to focus now. So if they do it, I'm sure we'll come back.
I think we are running late. Any closing comments from you, Abhijit, Anshul? Then we can end this session because we have speakers waiting for the next session.
Yeah, as far as I'm concerned, I said I'm slightly more optimistic, like people said. I think it's gloom, it's not doom. We just need to be strong. We just need to come back. I'm also back in the office. I feel good wearing a shirt, and I feel good. So I think it's it is the new normal. We'll all have to be very innovative. We'll have to find solutions, and we'll just have to maneuver ourselves right through. So it's not like it's all done. 6 to 8 months, everything's going to get back. Yeah.
Okay. So that's where we end. And thank you so much, everybody, for your time and for your attention. And thanks so much for your perspective here. And now I'll ask the next moderator.
Thanks, thank you so much.
Thank you so much.
Thanks everybody.
Thank you. Bye.
Hi, Narendra. Please take it over your session.
Hi. Yeah, great. Am I audible there?
Yes, we will.
Okay, great. Thank you so much. Thank you, Sarika, for that lovely panel. I'd like to first ask all my panelists to come on. I can see Mr. Goenka and Mr. Rangarajan. Is Mr. Anand here? Okay, I think we'll go ahead. We'll wait for once Mr. Anand comes, we'll sort of bring him into the conversation as well. But good afternoon, everybody. Just 6 minutes after 12 p.m. So good time to say good afternoon. Co-living and co-working, I think, can be fairly said are the two sunshine aspects of the real estate sector, not just Mr. Anand here. Thank you, Mr. Anand. I think it's fair to say that they are the sunshine sectors of the real estate industry, not just because of their business models, but because of the consumer reception, which has been very enthusiastic. For co-working spaces, it's the startups and the small companies that have taken to them. And for the co-living spaces, you have co-audiences such as students, and even as we're slowly starting to see young professionals, and as we will discuss, there are target groups that they're looking at as well. But there are challenges. I mean, just in last year, WeWork was the darling of the world, and now we've seen their corporate governance issues. We've seen their valuation get cuts. And last year in India, we saw a lot of startups coming, but the quality of the startups, the kind of infrastructure they were providing, the kind of goals that they were setting, and the kind of audiences that they were attracting, those are some of the challenges that had to be addressed. But that doesn't mean that there isn't any hope for the sector. And sort of to discuss that, we have representatives, founders, I would say, of co-working and co-living companies. So I'd like to welcome Mr. Abhishek Goenka of CoWorks, Mr. Suresh Rangarajan of Colith, and Mr. Deepak Anand of Hauser. Mr. Goenka, if I can come to you first. And I would like to sort of start this discussion with a bit of a juxtaposition. We're all going through the coronavirus pandemic right now. We're all stuck in our homes, or some of us may have taken the office for a day, but it's just for a day. But prior to COVID-19, what do you feel was your space that you thought would gain traction in the coming few years?
No, sorry, I think your voice was a little patchy. Can you just repeat the last part of your question?
Yeah, I'm sorry. Can you hear me now?
It's a bit patchy. Go ahead.
Yeah. I was asking, prior to COVID-19, prior to the pandemic, what did you feel were the trends in your space, in the co-working space, that would gain traction going ahead?
Sure. So, I think the big changes that happened in the co-working space is that the whole definition of co-working itself underwent a massive change, right? So if you take a step back, when co-working was just started, it meant people in hoodies and shorts crowding around a common desk and, sharing a workspace. That was really the origin of co-working. And I think if you look at the companies may still be calling themselves co-working, or like we still call ourselves co-works, but the concept has really moved to flexible workspaces, right? And are basically a shared workspace. So no longer is it about people crowding around a single table. If you look at our offering, if you look at the offering of what many of our other players in the sector offer, it's all private offices. It's only about sharing certain common spaces and certain common amenities. So I think that paradigm shift happened even before COVID. And to that extent, it created a good platform for the sector to capitalize on a post-COVID environment.
Mr. Anand, the same question. What were the trends in the co-living space that you thought would gain traction before the pandemic hit us?
I think I'd say more on, the technology side, as it is, we were trying to automate, whatever we could, in our product offering as well, more and more use of technology to drive, ops efficiency as well. I think it has become of, it is more and more important now to, see where all we could use technology, given that the entire, contactless, from the contactless housekeeping to, getting into a super aggregated, model. I think pre-COVID, all players, in the co-living space also were trying to become a full stack operator. I think that was the direction where we were also headed, where you provide everything, under one roof, which is a mega co-living, super aggregated with all the amenities, facilities, and of course, operate at a certain scale. I think that becomes even more important now going forward. Also, another trend that we saw was, the need for luxury co-living. I think, co-living started as a, as an extension of PGs, to start with, where you could go and stay in a particular accommodation. You didn't have to do a lot of, things yourself. And then, came full stack operators, like us, like many others in the market. But, our on TG largely, where, millennials who were just, about 2 to 3 years into their, working career. I think there also was a need for luxury co-living that we were trying to assess. I think, that becomes a reality now, the post-COVID era in, about 3 to 6 months from now, where people earning, sufficiently well also would like to, stay in co-living spaces rather than, renting an apartment on their own and, getting everything organized.
Mr. Rangarajan, did you notice the same sort of trends? Is there something you want to add?
Yeah, I think I'd like to add a couple of things here. I call it experience living. I think people have started focusing a lot more on experiences rather than owning assets. So I think that's a very, very important trend that we kept noticing. I was a developer myself. I was a real estate investor before that. So coming from the financial services and investment background, and real estate background, 2016 was a wake-up call for me. I think I started believing that people would value rental housing more than purchased homes. So Murli, I hope, is not listening to this comment of mine. But, I've been a great follower of that. And, I wanted to do something in that space because more and more people were taking to, this is a Uber, Swiggy, Zomato economy, right? I mean, people want to be detached as much as possible, not want to get more attached, want liquidity, which comes at a premium. Flexibility is so very important, whether it's co-working space or co-living space. All these trends were there prior to pandemic. It's got nothing to do with pandemic. In fact, you rightly said we are the sunshine in all the gloom that is there. I think that's because we were following this trend for about 3-4 years before the pandemic, and it'll further get consolidated post the pandemic because liquidity and flexibility is the king today. Kal ka kisne dekha is a very common term now among millennials. So they want short-term contracts, they want to experience living, and of course they want to keep conserve cash.
It's interesting that you mentioned the experience economy, because we have seen many of the stars of this experience economy pivot their business models right after the pandemic hit. I mean, suddenly, forget pivoting, they brought forward business plans that we heard wouldn't be seen for the next couple of years at least. Zomato and Swiggy have gotten into the grocery delivery business. Uber is suddenly talking about how its cloud kitchen is going to be its next big thing. I want to ask you, is that kind of pivot or is that kind of adaptation possible in the co-living space? And if it is, what sort of adaptations do you see?
Okay, Deepak, if you don't mind, I'll answer that first. So what has happened is, there is a merging of the living and working space that happened in the last 90 days, right? There is thin line between a co-working and co-living that has also evolved. So what has happened is, work from home has become a trend. It has become more of a necessity. Of course, it posed a lot of challenges. Business continuity became a threat. BCP plans got tested. Disaster plans got tested. People started taking out desktops from SEZ. We found out all kinds of stuff. And then, global capability centers like Goldman Sachs and Accenture started telling their employees to work from home. And these guys were actually giving complaints saying that, sir, I don't have power in my house. There's no internet in my house, which is a common problem in, southern cities especially, right? And, that was not something taken very, very easily with, the global counterparts. So which means that, creating a proper co-working environment or a working environment within the living space, forget the co in both of this. So live plus work in the same place in a consolidated manner, what we call the evolution of an integrated campus is something that, is a natural extension. Whether, Abhishek now starts offering living beds or whether I start offering working desks, so basically the pods will start evolving is what we think very, very strongly.
Mr. Anand, I see you smiling. I think you have something or a partnership to offer.
I think back on, Suresh has covered, most of it. I was about to say that, going forward, I think there is no need to pivot the model because, there is a inherent need for co-living that exists always. I think, we'll have to do some structural changes in our properties also going forward. There was no need for a WFH compliant room, earlier. Only very, very few people wanted a work from home compliant room. I think going forward, all the rooms that you have will also have a work desk and a chair. instead of giving these millennials an expansive lounge, and a couple of hangout areas, I would rather convert some spaces into the work desks, or collaborate with a co-working player and have a couple of desks per property for co-working as well, which could enable these guys to work from home. What we've also observed is that irrespective that the companies tell you to work from home or not to work from home, you still are required to go to the office a couple of days in a week. So we were initially worried that the demand could dry up, because people let's say if I have a property in Gurgaon, people stay in Lucknow, can you just operate from Lucknow because the employer has told him to work from home? I think that is not correct, because the guy still will need to show up at least 2 to 3 days a week. And on the rest of the days, I'll have to tweak my product in a way that I give him a conducive environment within the property to sit and work from home as well.
Mr. Goenka, I'd like to flip that question for you and ask you, because I recall that when we were having the discussion prior to this panel, you mentioned about how demand and supply in the co-working space have sort of gone in tandem, whereas both have risen in equal measure. So, I mean, what has investor reaction been following the pandemic? Have they been talking about high valuation cuts like we've seen in other industries, or have they said, okay, let's wait and watch? What's been the reaction, at least for the co-working space?
Sure. So just before I answer the investor question, just a quick comment on what Suresh and Deepak said. I think even before the pandemic at co-works, I have always been saying that work is an activity, work is not a destination, right? And, that's actually the COVID situation has just proven this line of ours. So we are not really worried about this whole work from home concept. We strongly believe that living, working, recreation are all distinct activities, and there will always be a need for specific offerings for each of these distinct activities, right? So to that extent, maybe at the cost of slightly disagreeing with Suresh, I don't really see beds and desks coexisting for the longest period of time, or even if they coexist, it's for a temporary part of one's day and not necessarily for the entire portion of one's day. Coming to your question on investor sentiment, I think investor sentiment in general across sectors is low, and I think that's a combination of maybe 2 or 3 factors. One, I think investors will not underwrite any deal today because it is very hard for the company to underwrite any projections, right? Given that the situation is literally changing every day, even if you're reimagining your model, pivoting your model, it's very hard for anyone to take a view of what will this model look like 3 months, 6 months, 1 year, forget long term, right? So the projections and the ability to underwrite any numbers itself are so difficult. And I think that is not very different for, let's say, the co-working sector. The only thing I would, however, add is that in the co-working sector, it is almost now universally accepted hypothesis that the demand for flexible workspaces will dramatically increase. So if you talk to any large occupier, almost all of them are saying that they would rather not extend any of their long-term leases and would rather take distributed spaces across the length and breadth of every city. So to that extent, I don't want to speak for co-living, but at least for flexible workspace side of things, investor sentiment is actually very strong. But having said that, I don't see deals happening in a hurry just because of the first point I made.
Mr. Anand, would you like to add from your perspective?
I think I agree with what Ashish just said, that there will be a need for co-living and co-working spaces both, irrespective whether you do a work from home or whatever. I think the only tweak that we need to do is on the product offering moving forward.
Tweaks would you sort of say would have the most impact?
Sorry, say that again, Narinder.
Yeah, I was asking, what would you feel have the most impact?
No, we couldn't hear you.
Can't hear you.
Hold on, please. I'm sorry. Am I audible now?
Yes.
I was asking what Mr. Anand mentioned product tweaks. What sort of tweaks do you feel would have the most impact?
Is the question to Anand or to me?
To you, yeah.
Okay, so basically the investor sentiment, as Abhishek rightly said, I think has taken a beating at this point in time. However, I think the entire community understands that rentals in general are strong counter-cyclical measures for any recession. So, especially residential rental, time and again over the last many decades have proven that, it exactly outperforms during a recession. So a product mix is in the right form would be that, at this point in time, hospitality, retail, all that is looking very, very grim. But warehousing, shared working spaces, shared living spaces look very promising, especially, emergence of a category called buy to let will come in, where institutional investors will start investing in products that are specifically designed, made, and delivered for, I would say, rental products.
So when it comes to all of this will require some sort of, obviously, capital expenditure. And what do you feel will be the terms that investors will set post-forward to sort of have access for companies to have access to this capital?
Yeah, I think any unit economics focused business, a profitable business is what the driver for investors would be. And in this kind of a business, whether it's co-living and co-working, it's just not rental arbitrage. Any business which is just focusing on a rental arbitrage is going to have tough time because they have to manage both the tenant and the owner expectation. But if you are bundling a whole host of services, which cannot be detached from the real estate. Real estate is provided as a service, not as a product, or not just as a plain vanilla, asset. Then suddenly things start looking better and different. Because I know this looks a little maverick, but you have to get your tenant totally used to it. You have to make the tenant a slave of your services. Only then you can succeed. And suddenly then the dynamics change. Then you are a profitable business, then you are a EBITDA positive business, and then the investor sentiment changes. Merely a rental arbitrage or a brokerage model ain't going to work.
So if I can put that question to Mr. Goenka, you mentioned that that you don't see a lot of deals being written for the factors that you've already explained. But if a deal is written, do you see investors coming in and saying, okay, we're going to take a percentage of equity in your company, or we are going to set a different in the deal structure?
Sorry, your voice was a little patchy, so I think I've heard your question, but I missed.
I was asking what sort of terms do you think?
Well, I think investors are very smart, so they decide the terms. It's very hard for me to tell you what terms they will ask, right?
But you are the one.
And it also depends really on what kind of investors you're looking at. I mean, as CoWorks, we are very clear. We only want an equity investor. We are not looking at structured debt. I think, unfortunately, in my view, many of the deals that we've seen in the co-working sector have all been debt deals, and I think this business is not capable of servicing high cost debt, and therefore, in my view, we need to find and see more equity partners coming into the sector. As Suresh said, it is all about unit economics. The unit economics are very positive. I think there was several reports. I was reading something from Edelweiss also recently, which shows that the economics for somebody working out of a flexible workspace are significantly better than using your own office. So we really need to find equity investors who understand the core of the business and are willing to put a value to it. I think if anybody looks at raising structured debt, that's not a preferred fundraising model in my view.
And Mr. Anand, I'd like to come to you on the topic of profitability and growth.
Sure.
I think has affected your own.
I think, Narendra, if you've noticed, the shift in investor behavior has started much before the pandemic. the investors had started looking at, unit economics, sustained, long-term sustainability, growth over, just the short-term, vanity metrics like GMV, top line, or, gone are the days of, someone following growth at any cost. I think so. It has got nothing to do with the pandemic. I think it started much before that, and we've observed, a couple of, examples in the market in this space, shared living or, co-living. I think more and more investors will now start looking at the business's ability to sustain cash, a startup's resilience to deal with, any unexpected events, such as pandemic, would also be very, very important going forward.
And I've specifically from two other aspects, one being your target audience and the kind of infrastructure that you provide. How do you see these two being impacted going forward? A new set of target audience members coming in, and do you see different sorts of infrastructures like these new audiences?
If you're talking about the brick and mortar aspect of it, I think we were all geared up, even before the pandemic, because, we've been only getting into, full stack co-living model. So I think there is enough room to improve the current infra at the property level only. I think the only behavior which, would have changed in the minds of target audience is the need-based, stuff of, operating out of, their, rooms or the properties where they stay, for the next 3 to 6 months and, maybe 2-3 days a week going forward as well. I don't see any challenges there. And of course, the new properties that we scout, for now are obviously, all WFH.
And Mr. Rangarajan, same question. Also, I'd like to ask you one more thing. From an audience perspective, do you see yourself expanding your offerings? And if so, to what kind of audiences are you going to expand them?
Yeah, a couple of things. First, let me tell you about the target market. We are looking at a target segment between 18 to 32. I think that has now got expanded to about 37, 38, because I see that the buying age of real estate is getting pushed by another 3 years because of the credit squeeze that's going to happen, the uncertainty in the job market, the pay cuts, etc., is going to further affect. So I'm talking about not just co-living, but I'm talking about the rental housing market in general, which starts at the age of about 18 and can go on until about 37, 38. So we are looking at a 20-year life cycle. And in this, it starts with a student hostel, then it moves into a young professional living, into a luxury living, into a live-in couple, into a then a young couple, and then a young family before they actually move into a family home, pretty much like in the Western market. So I guess there are about 6 or 7 products that need to be offered in the rental market, and which can be loosely termed co-living, because all these are service homes, managed homes, which come with a lot of service offerings bundled with it. So in terms of expansion of offerings, I think one of the biggest things that we saw during the lockdown phase was, people were so reliant on office canteens and darshinis or suksagars for their food, and suddenly when both got closed, they had money in their pocket, but they couldn't buy food, right? So food becomes a very, very important model. It goes very hand in glove with living, and it's one of the most basic essentials for anyone. So rental housing, co-living with subscription-based food, and then obviously internet, which becomes at most essential. I think even in the last session we were talking about 25% jump in internet subscribers. The bandwidth consumption, both for office data as well as for entertainment purposes, has become very, very important. So how do you provide secured network? How do you provide for seamless work from home, and also provide them larger bandwidth for their entertainment consumption is something which became very, very important. And that's a product design.
Okay, I believe Mr. Anand has had to log out because of a prior engagement. But as a final question, because I'm acutely aware of our time constraints here, Mr. Goenka, in the co-working space, or even generally in the larger prop tech segment, do you see a wave of consolidation coming? basically brought on by the pandemic, or was this something that would have happened regardless?
I think it would have happened regardless, and I think sometimes numbers and statistics are misleading. People talk about there being 400 players in the co-working segment and so on, but I think that's a misleading number, because if you have one extra room in your home and you set up 10 workstations and you call yourself a co-working operator, I mean, I have nothing against somebody doing that, but I don't think that's a serious business that's just using extra space. So firstly, I think we need to look at the right number of players in each of the segments, right? Secondly, as I said, co-working itself now has multiple segments. Some of them are still focusing on being true co-working, more for startups, 2-seater, 3-seater kind of requirements, whereas players like us and some of the others have moved on to becoming very enterprise focused. So I think we need to first sort of correctly segment each part of the larger industry. And then consolidation, I think, is inevitable. We've seen that pre-COVID, we'll see that post-COVID. It may accelerate a little bit because obviously some of the players who did not have a lot of strong customers have seen a lot of distress and because the back-to-back costs are still very high, I think their survival may be at stake. So yes, to some extent, consolidation will increase, but I think that was bound to happen irrespective. Because this
are you going in for an acquisition soon? Are you looking at certain players in the market?
So we evaluate it. I think for us, the kind of premiums people expect are not something we are ready to pay, because for those premiums, we can equally expand on our own. What we are actively pursuing as a strategy in the market is an asset-light growth. So we are looking at kind of a management contract basis acquisition, and that is a conversation we've initiated with many players already.
Mr. Rangarajan, same question.
Yeah, I think co-living as a sector started a little later than co-working. So I think in terms of the newer players coming in was itself slightly later. So maybe we are about 2 years behind co-working industry in general. So 2019 was the first year when a lot of new players started mushrooming. Of course, the mom and pop shops, like Abhishek mentioned, are not going to be termed the true operators. Today, there are only a handful of operators, maybe 5, 7, 8 of them. So consolidation, I think, is still early days. There is enough opportunity because, like real estate is a gas tank business, which means that, you are a champion in your own zone. So it's still very difficult. There are players who are very good in Delhi. There are players who are very good in Bangalore and Hyderabad and so on and so forth. So I think it will take a few more days before we start talking about consolidation.
Okay, great. I think there are no questions for our panelists as of now. So I would request all our attendees to connect with them offline. But thank you both, and obviously Mr. Ranat, so much for joining us today. It's been a very engaging discussion. And with that, I think, Wade, do we have any other items lined up?
We are done with this session, and we are over. We thank all of our delegates and speakers for joining us here. Thank you so much, guys. Thank you so much.
Thank you.
Thank you so much, everybody. Have a great week.
Thanks, everybody. Thanks.
Bye.